Excellent. Now that we're recording, the materials that you need are here on the TTS portal. I dropped the link into chat. You can navigate to the interview prep session, and then the first PDF that you want is right here. And let's go ahead and navigate over there and get started. We're going to go until 1 p.m. Pacific time, and 4 hours I know is a long time to sit. So what we're going to do is take 2 short breaks in between now and then. Usually how that works out is I'll go about 70 minutes or so, and then we'll take a 10-minute break or so, and then we'll come back to another 70 minutes, take a 10-minute break, and then come back and finish up that last hour. So that's the plan. And let me do this again now that we had about twice as many people from when I first asked it. Give me a thumbs up if you've got the PDF open, you're ready to go to get into the material. Thanks, Kareem. Appreciate that. All right. Noah, Ariel. Okay. Arjun. Suju. Okay. Excellent. Wow. Even more people joining here in the room. But let's go ahead and get started. So here's the plan since it looked like we got critical mass. The plan is to work through this book, and there's 2 parts to this book. The top section here is the behavioral or fit topics. And then down below are the technical sort of valuation topics. And in designing this program with Career Services over the years, they said, hey, we do a lot of work with our first years going over the behavioral, their resumes, getting their ready for shaping their narrative and interviews and so on. But we're not ex-bankers or private equity professionals. So we'd love to have you focus on the technical topics. So that's where I'm going to focus this session, in the technical valuation topics, but it's important not to forget about the behavioral fit topics as well. So I included these items in here. We had them, so I just went ahead and included them for you. Hopefully you get some value out of going through the behavioral topics as well, but the focus is on the technical valuation topics. And do me a favor, drop into chat the answer to 2 questions, and it could be just yes, yes, or no, no, or yes, no, or whatever it is. 1, are you a career changer? Have you worked in investment banking before? If not, no. And what role are you looking to go into? IB, PE, or IM? So yes or no, and then comma, IB, PE, IM. Just give me a sense for the group here. Okay, wow, this is super helpful. This is super helpful. Thank you. Okay, it looks like virtually everyone has not worked in investment banking, so you're looking at transitioning, which is great. This class is exactly for you. Most investment banking associates are career changers. Why? Analysts do not want to go back for good reason. You'll experience that, I hope, when you get a job in IB, and it looks like pretty much is in IB. So look, I'll gear this, thank you for that feedback. I'll gear this session particularly for career changers interested in IB, which is also why we're going to focus on the technical topics that have tripped up individuals in your same seat looking for investment banking jobs. So that's the focus. But before I get into that, let's flip over to page 6. And there's something I want to talk about here on page 6 before we get into the analytical technical portion. This idea here, objectives. Do me a favor, augment this however you want. I'm using PDF, just comment. You don't need to edit in this, you just comment. It's or however you're taking notes. It says clear, concise, and compelling, but let's add something here. Clear, concise, and compelling is what we're looking for with respect to telling your story. And of course, that makes sense for the behavioral section of the interview. Walk me through your resume. What are your strengths, weaknesses, and so on. But I want to particularly discuss with you today how you can sound clear, concise, and compelling with respect to the technical and analytical portion of the interview. Because as we go over the concepts, you'll see that, and hopefully my hope is that you've seen some of these concepts in your accounting or finance classes, that you've seen some of the corporate valuation concepts in that class previously a couple weeks ago with that instructor from Training the Street on corporate valuation. But now that you know it, the focus of this class is to take you from I know it to I can talk about it and have my responses resonate with the professional interviewer. So preparing for an interview is different than taking an exam on campus. We need to elevate our understanding of the material so that we can not only talk about it, but also talk about it in a way that's going to resonate, like you sound like you know what you're talking about to the interviewer. So that's the focus. I hope you've seen all the concepts that we're going to discuss, but our focus today is to get you from understanding those concepts to how do I talk about it? How do I really understand these concepts enough so that I can shape a response that's going to resonate with the interviewer, and they're going to want to hire me, as opposed to saying, hey, this person needs more work. That's where we're focused. Obviously, being confident and fluent in financial knowledge is important. Great articulation leads someone to believe that you're intelligent, so that's important. But notice I put up here as the fourth objective, enjoy the meeting. Do me a favor, drop into chat. Why would I say it's important to enjoy the meeting? Drop into chat. Why would I say it's important to enjoy the meeting? Why do we want to enjoy the meeting? Kelsey, that's good because they'll enjoy it too. Perfect. What else? Damiola, that's perfect as well. You're more relaxed. You feel at ease with the profession. Yep, that's exactly right. Arjun, you're more relaxed. Yes, yes. Yeah, WL, excitement, passion is contagious. Absolutely, absolutely. Yeah, you want to show excitement, eagerness, passion for the job, all that stuff. Yeah, yeah, Henry, that's spot on. All right, this is great. Let's explore this a little bit more. Kelsey, are you able to unmute?
Yes.
All right, perfect. So you were one of the responses in chat. And team, I hope this is going to be an interactive session. And frankly, Kelsey, let me just share with you that your answer doesn't matter, right or wrong. We just love the contribution. So everyone, let's give Kelsey a round of Zoom reaction hand claps right here. Kelsey, even before you answer, just sit back and bask in the glory of the hand claps from your peers. Let's go ahead and give it up for her, team.
Thank you, guys.
All right, Kelsey. So you talked about some of the ideas here because they'll enjoy it too. What's some of the benefits of you enjoying it and them enjoying it? Let's think about this as a spectrum, Kelsey. And your response and many of the responses about being relaxed put us right in the middle of that spectrum. Let's go to the right and look at upstream or downstream. What's sort of the benefits of you enjoying the meeting? Other people mentioned feeling relaxed and confident and at ease. What's the benefits of that? Like, why do you want to be in that position, Kelsey? What's the benefits of that? Let's move along the spectrum here.
Because interviewers usually base their decisions off of how they feel. And if they remember you and if they're enjoying their time with you, then they'll have a good memory and a good feeling when they're going through the different applications.
Yeah. Kelsey, that's perfect. Imagine, put yourself in the shoes of the interviewer, right? Especially if they come to campus, they're doing one person every 30 minutes over an 8-hour day. They're seeing 15 to 20 people. Are they going to remember everything about every person? No, but Kelsey, what you do remember a lot of times is how that person made you feel. So I completely agree with that. And then Kelsey, let me help you out. If we go one more step on the spectrum, I think the benefit of all that, of feeling relaxed and confident and enjoying the meeting, and then getting a sense that they're enjoying it too and they're getting a good feeling. And Kelsey, we can get in the mode where they're thinking of you like a colleague now, and you're having a conversation as opposed to an interrogation. Also on that spectrum, what does that lead to? It leads to hopefully you getting the offer, right? So that's the ultimate benefit of that. Starting the middle, getting the ultimate offer. We see the benefits of that. But Kelsey, how do we get in? And this is important. This is what I want to talk about right now before we dive into the analytics. How do we get in that position of feeling relaxed, enjoying the meeting, being confident so that we can realize the benefits? What's the start of all that cascade?
Probably like knowing what you're talking about and being confident in the information that you're conveying, and so you can deliver it in a good way.
Yeah, perfect. Preparation is a huge part of that. That's why we're doing the class today, and you have access to the recording. And Kelsey, let me help you out. Tell me if you agree with this or not. But I think that whole cascade of items, even before preparation, I would say that that begins with your mindset, right? What's your attitude? What's your mindset? Are you even willing to put in the work to prepare so that you can realize the benefits all the road? When you go into the interview, Kelsey, there's a lot of things you don't have control over, but you do have control of your attitude and your mindset to put you in the position to think about, oh, I'm having fun. Let's enjoy the meeting, even if it's not going well. And maybe they're like, hey, you know what? I like their attitude. They're smart enough. I can teach them what we need. Let's go ahead and do it, right? So do you agree with that? This idea that I think it all starts in your head, the attitude, the mindset that you take. Would you agree?
Yeah, it sounds like it. I would agree with you.
So if we think about that, Kelsey, and the reason why I focus on this is I've seen over the years from my experience, a lot of people just getting wrapped up in their own head through the preparation and forgetting that it's really important to take a step back, see the forest for the trees, and think about your attitude and your mindset, because that starts a whole cascade of positive items like you and I talked about. Kelsey, one of my friends in business school, when she was going through recruiting, she's very bright, but also a little on the hesitant side, and went through, as we all do, Kelsey, paralysis by analysis, right? And what she noticed was she didn't perform as well as we all thought she would in the initial stages of the interviews, but she was smart enough to realize what was happening. And so I'll tell you, Kelsey, on interview day, she became the most talkative person you'd ever met, a complete 180. She'd come down from her building in New York, chat up the doorman waiting for her ride. On the ride over, she'd chat up the driver. While she was in reception, she was talking up the receptionist. And she made sure when she was the first one walking through the conference room to the interview, she was asking questions of the interviewer because she was really authentically engaged with what was happening with them. But also, Kelsey, what that meant is she was out of her own head and she wasn't going through paralysis by analysis. And that ended up performing very well. But again, she started with the attitude. And Kelsey, since we're all friends here, we're hanging out for 4 hours on a Friday. I'll tell you candidly, have you all heard of that song by, I'm definitely aging myself, by Eminem called Lose Yourself?
Yeah.
It goes dun, dun, dun. You got one shot, one. Like, Kelsey, don't tell me I will karaoke the shit.
I love Eminem, so we're on the same page here.
Yeah, Kelsey, that song was on repeat in my headphones over and over again to get me in that mindset to go in and crush the interview and want to share what's going on. So I really think about, Kelsey, what's going to be your theme song, right? Think about what's going to be your theme song for everyone. Is it Despacito? I don't know. Shake It Off? Who knows, right? But think about that. What can get you in that attitude, that mindset? Because Kelsey, don't sleep on this. We're going to talk about analytics and technical components for the rest of it. But taking a step back and having this attitude and mindset in the back of your mind really is going to shape your interview. Kelsey, what do you think? Does all that make sense?
It certainly does. Yes, very compelling.
Okay, awesome. So the next thing we want to look at is, like I said, I'm going to jump over the fit portion, but we had the slides, so I brought them in here. We're going to focus on the analytical portion. Kelsey, the other thing I want to mention is this subtext. Regardless of how the interview comes at you, don't get lulled into a false sense of security. It's unlikely this would be a pretty aggressive interview. Can you do the work? Do you want to do this particular work? Are you going to work hard? Are you going to take ownership, right? That'd be a pretty aggressive interview, but don't get lulled into a false sense of security, because you want to play the interview at the level of the subtext, regardless of the intensity of the questions. Because what we see is people are primarily hired for two reasons. One, they're able to demonstrate how they're uniquely valuable, their value proposition. And two, how they're someone with whom the interviewer would want to work. Can you have that interviewer see you as a colleague discussing topics that they would on a regular basis? That's where we want to go. All right. Kelsey, great job. Everyone, let's give it for Kelsey again right here. First one to take a cold call off the bat. Thank you for that, Kelsey. Great job.
Anytime, Scott.
Excellent. All right, so let's go into the analytical section here. Again, you can come back on your own time to the fit behavioral part. Many of you I know have interviewed for jobs before business school. Many of you likely have interviewed others. So on page 33 is where I'm at right now. Many of you mentioned, virtually all of you mentioned you were career changers looking to go into IB. And so you're likely learning accounting for the first time. Would it be helpful if so every year we do a survey after interviews. So it comes out in February and it asks just a few key questions, which was, what were the most common behavioral questions? What were the most common technical questions? But also, what were the challenging behavioral? What were the challenging technical questions? This deck has probably hundreds of actual interview questions. I created this deck. It's curated from the responses in that survey. So I've easily seen hundreds of responses over the years of recent interview questions with thousands of the questions. People put in multiple questions in there. This deck is shaped and curated from those questions that come up recently in investment banking interviews. Would it be helpful for you all if I went through the accounting hot topics that we see come up time and time again in that survey? Would it be helpful if I boiled the ocean of accounting topics and just focused on those key items? Okay, I'm getting a lot of yeses here. Let me go ahead and break that down. So of the things that you want to understand, a lot of companies, you'll notice, are becoming more subscription model based. And so even outside of technology companies, deferred revenue as an important piece of understanding the company's business model. Also, a few years ago, the lease accounting rules changes, i.e. operating leases, finance leases, understand what those are. The accounting rules just changed, so this is new. Investment bankers like asking about it. Also, one thing that separates individuals is their understanding of deferred taxes. And then also part of investment banking is M&A. So understanding M&A accounting or equity investment accounting, which part of that is non-controlling interest. I'll move that in a second. And then you should also understand the accounting around debt, equity issuance, and then also purchase of CapEx. How do these items roll through the financial statements is something that you want to understand. So there's the 1, 2, 3, 4, 5, 6, 7, 8, 9 topics that we see it come up time and time again in that survey. So if you knew these 9 topics, 9, 10 topics, you'd have 80% of the accounting questions squared away. Now, how do questions around these topics come into play? Typically 2 key ways. The interviewer typically asks, explain a business situation which deferred revenue or non-controlling interest is created and how you would account for it. Or walk me through a transaction of purchase of CapEx or issuance of debt or equity or an M&A example. So these are the 2 forms of the question for these topics, which means that the best prep includes being able to walk through all 3 statements in some detail, understanding how accounts are dependent on one another, understanding how accounts are projected. Let's look at an example of this. How accounts are projected. I start with PP&E net 1 year forward. How do I derive that? Imagine you're sitting in an interview and they ask you to come up with the first projected year of PP&E net. What would you start with? What would you add? What would you subtract? How would you arrive at the ending balance of PP&E, let's say 1 year past the historicals? If you think you've got it, drop it into chat. What would you start with? What did you add? Caitlin, solid, solid. Caitlin, and we'd start with, before we add on purchases and depreciation, we'd start with PP&E net. Yes, for the beginning balance, exactly. And then Caitlin, here's CapEx. And Caitlin, This CapEx, is this from time 0 or time 1, Caitlin? Nice job dropping the answers in chat. I can see them there. CapEx from year 0 or time 1? So this CapEx is over the period. So it's the new CapEx after the PP&E net. So what are we spending over the next year? And then we're going to subtract out depreciation expense also from that year. And then Caitlin, let me give you a bonus. Any asset sales from that year, that's going to get you the ending balance of PP&E net. So that's one example of understanding how accounts are projected. Nice job, Caitlin. Everyone, let's give it up for Caitlin in chat. Here, go ahead and give Caitlin a round of Zoom reaction hand claps. Well done. So you should understand how the debt is projected, how the equity account, retained earnings account, how inventories and accounts receivables and so on are projected and linked between the core financial statements, not only the balance sheet, but the income statement and cash flow. Also, valuation is based on cash flows. So understanding the impact of cash flows is really important. Let's make sure we're squared away before we get into some valuation topics. Do me a favor. If an asset goes up, is that a source or use of cash? Drop it in chat. Asset goes up, source or use of cash. Asset goes up, source or use of cash. Yeah, perfect. That's a use of cash, which means it's negative on the cash flow statement. Perfect. Nice job, team. Nice job. And then what about a liability or equity account goes up? Is that a source or a use of cash? Drop that into chat. Yeah. Arjun, Kelsey, perfect. Henry, well done. Grace, Felipe. Yeah. Leon, Ariel, nice. Jose. Yeah. Source of cash. And that's going to show up as positive on the cash flow statement. And what I'd like to do with you is build some universal truths so that you can take some items, some statements into the interview and know that they're going to be true. So I want to build some universal truths for the cash flow statement. And when I say universal truths, what am I talking about? Like stuff that's always true, right? Universal truths. Items like, I don't know, always be nice to the person that has access to your toothbrush, right? Like that is a universal truth. But for an interview on the cash flow statement, let's build some universal truths. Depreciation, amortization on the cash flow statement, always what sign? Drop plus or minus in the chat when I say these. Depreciation, amortization, always what sign? Yeah, Felipe, Arjun, perfect. How about stock-based compensation expense? In cash flow from operations, stock-based compensation expense, always what sign? Yeah, positive. Again, just like DNA, it's a non-cash add back, right? How about CapEx, purchase of intangibles, always what sign in cash flow from investing? CapEx, purchase of intangibles, always what sign? Yes, exactly. Negative. Exactly. How about in financing, dividends, repurchase of stock, always what sign? Dividends, repurchase of stock, always what sign? Negative. Exactly right. Just like repayments of debt, always negative. Issuance of debt, issuance of equity, always positive, right? So we build up some universal truths. How about in cash flow from operations? How about changes in working capital? Change in working capital, always what sign? Changes in working capital. Changes in working capital, always what sign? So team, I left that one for last because changes in working capital can go either way. It can be positive or negative. Kelsey, that's exactly right. Kelsey and Ariel, like most correct answers in finance, it depends, get you there 80% of the time, right? So, but most companies have current assets greater than current liabilities, which means assets are growing faster than liabilities, which means that working capital is a use of cash. Most healthy companies have changed working capital as a use of cash. However, some companies have changed working capital particularly those with subscription business models as a source of cash. Apple is a big example of that. Apple, very healthy company, but when they grow, they have changes in working capital as a source of cash. The other one that can go either ways is deferred taxes. Deferred tax assets, deferred tax liability, one sign when you're building up, another sign when you're going away. Of the major items on the cash flow statement, change in working capital and deferred taxes are really the only two that change. The other one, you can build some universal truths around it, and hopefully that's helpful when you're walking to an interview. You know some things that are definitely going to be true. Let's continue looking at some of the accounting finance topics. I mentioned previously that you want to be clear, concise, and compelling. In that interview prep survey, one of the most common questions that we see is walk me through the core financial statements. Now, Kelsey, back to our idea about being clear, concise, and compelling, not only for behavioral responses, but also for technical responses. You should be able to answer this question in less than 60 seconds. You should be able to walk through the core financial statements in less than a minute. And here's what I'd like to do. I want to give you some best practice answers today, but also I want to give you a chance to practice. So play full out with me. You're going to get the most out of this class when you do. I'm going to go on mute. I'm going to give you 1 minute, and I want you to practice. You just stay on mute. Imagine you're sitting in an interview. Walk me through the core financial statements. Ask, how would you answer that? All right. I'm going to give you 1 minute. On your marks, stay on mute. Just play full out with me today. On your marks, get set, go. Walk me through the core financial statements. What would you say? Okay, time. That was about a minute there. How'd you do? Let's talk about, would it be helpful if you all would like to do it, would it be helpful to hear a best practice answer? I'm happy to walk through this. Would that be helpful? Would you be interested? Would you all be interested in that? Noah, I see a big thumbs up there from you. Leon, we'll talk about that on the next page. That's a great question, Leon. Noah, you were one of the first ones to say, yes, let's do the best practice answer. Noah, do you have a phone near you or something with a timer? All right, perfect. And Noah, if you're able to unmute, why don't you ask me the question and I'll walk through it and you can time me for everyone. Just 1 second. Let me get a sip of water here, Noah. All right, when you're ready, ask me the question, and then when I start the timer, Noah. Does that sound fair?
Sounds good. All right, give me a second here. I'm gonna go stopwatch and I'll stop you in a minute. All right. So walk me through the financial statements.
Sure. Let's start with the income statement, which measures the profitability of a firm over time. The income statement starts off with revenues, and then I subtract out operating expenses, financing expenses, and tax expenses, Noah, to give me net income. Net income under the indirect method starts off the top of the cash flow statement, which measures the inflows and outflows in a business also over a period of time, and has three sections: cash flow from operations, investing, and financing, which all sum to give you the net change in cash and help you derive the ending cash balance. The ending cash balance at the bottom of the cash flow statement flows to the top of the balance sheet, and the balance sheet helps you measure in the financial condition or perspective of the company, health of the company at a single point in time, and also has three sections: assets, future economic benefits; liability, sacrifices to those benefits; and the residual of assets to liability, equity, which is also impacted by net income. Time.
Yeah, I was 58 or 59.
58, 59 seconds. All right. Team, what do we think? Did that sound clear, concise, compelling, right? All right, we're about 30 minutes in. So if you wanted to come back to the recording, thanks Noah for doing that. If you wanted to come back to the recording and look at that walkthrough, then you can do that. But again, it's less about copying mine and more about how you think about these topics so that you can get through them in a clear, concise, compelling way and have your responses resonate with the interviewer, okay? Give me a thumbs up if that makes sense. Does that work? Okay, perfect. Go to page 39. On page 39, go to page 39, drop in chat. Let's do this quickly. Drop in chat as fast as you can. What is depreciation expense in year two? Drop it in once you see it. Depreciation expense in year two, drop it in. $25. All right, perfect. 25. I'm getting 25. A lot of people getting 25. Is that correct? Is that depreciation expense in year two? Yeah, Leon, that's right. That's right. None, Arjun, none is in COGS. It's all right there, but that's depreciation and amortization. What is depreciation expense in year two? Not 25. What's depreciation expense in year two?
Can I take a stab?
Sure, Arjun.
I might be wrong, but is it the change in net PP and then you like back out the CapEx spent for the year?
Yes, that's exactly right. Ariel's got it. Arjun, this is an example that Caitlin and I talked about on the previous page. You basically described this equation right here, Arjun, and that's what we want to use, right? Demiola, that's exactly right. So Arjun, let's go ahead and calculate that. And this is one example. We've seen it here recently, people being handed during their investment banking interviews, Arjun, like a 10K or an annual report, and then questions being asked about it. Like if they say, what is depreciation expense in year two, you should be able to figure it out based on this information. So let's look at that equation here. The equation here was PP&E in year two. That's going to equal CapEx. Oops, this is PP&E in year one plus CapEx minus depreciation. And so Arjun, give me the PP&E value in year two. What do you see there on page 35? What do you see?
310.
310, perfect. And what's PP&E in year one?
250.
250. And then you are exactly spot on. You said we need to adjust it for CapEx. So what is CapEx in that second year?
75.
75. And now everyone, there's no asset sales. So you should be able to solve for depreciation expense in year two. And Arjun, with that equation now, what do you get for depreciation expense in year two?
15.
15, exactly right. 15. So Arjun, what we see here is depreciation amortization is 25. of that, we figured out depreciation was 15, which means that amortization is 10, right?
Hmm.
So that's the difference there. Again, an example of knowing how to estimate each account and how it's projected. Arjun, before we go on to the next question, let's take any questions on this right here. But in the meantime, everyone, let's give it up for Arjun. Nice job picking that up. 15, well done. All right, let's see if there's any questions here. Okay, Arjun, now that we know that depreciation is 15, one question that comes up in our survey, excuse me, quite a bit. And Arjun, frankly, this was a question when I was going through banking recruiting, is walk me through the impact on the financial statements if depreciation goes up. Very common question we still see pop up because it forces you to connect all three financial statements with an actual item that would impact your model if you're building out a financial statement for one of your clients. And so, Arjun, let's look at this. What's the impact on the financial statements if depreciation expense goes up by 10 in the second year? And again, Arjun, you should be able to answer this in a clear, concise, and compelling way. So let me give you all 60 seconds again, and then I'll give you a best practice answer. How would you answer this question? Walk me through the core financial statements. What's the impact if depreciation expense goes up by 10? Go ahead and start now. I'll give you 1 minute. How would you answer this during an interview? Go ahead, go on mute. How would you answer that? Okay, that right there is exactly 1 minute. That right there is exactly 1 minute. Again, I think if you play full out with me today and practice, you're going to get a lot out of this class. Let me give you all the best practice answer, how I would think about answering this, at least being able to do that in a minute. And let's do this together, actually. So what's the impact on revenue? Depreciation goes up by 2. What's the impact on revenue? Yeah, no impact on revenue. Depreciation goes up by 10. What's the impact on EBITDA? EBITDA, it moves by how much? That's a trick question. EBITDA doesn't move. Depreciation is below EBITDA, so no change to EBITDA. If depreciation goes up by 10, then that means that the expenses are higher by 10, which means that profits are going to be lower by 10. If profits are lower by 10, then that means my taxes are lower. And what all did you use? Drop in the chat. What all did you use for the tax rate? I didn't give it to you. I just said depreciation goes up by 10, which is similar to an interview. Yeah, Arjun 20%. Saskia 40%. Yeah. Henry 30%. Yeah, perfect. Okay. So some of you assume something. Some of you assume something. During an interview with an investment banker, if they don't provide you key piece of information, they leave it out. What should you do? Should you ask to clarify to make sure you and the banker are on the same page who's evaluating you? Or should you just assume something and move on? Drop in the chat. Ask or assume. What do you think? Ask or assume. Ask or assume. What do you think? Good, good. This is why we're doing this. We see a mix of ask and assume. I think this is one of those situations where you want to assume something reasonable and defensible, and then just keep it moving, right? Because Arjun, what I want to try and avoid, imagine this, right? The investment banker, and maybe they're a little salty. They've got a lot of work to do. They don't want to be there. They're filling in for someone. They took an early morning flight to make it there on time. And you ask them, I'm missing a tax rate. What should I use? And they say, why don't you use 37.5%, right? Like, what the fuck? How are you going to calculate that? So I think this is a reasonable place to assume something defensible, 20%, 25%, but also, more importantly, something that's easy for you to calculate. And then assume something reasonable, defensible, and keep it moving. I think that's probably a better way here instead of asking, right? So let's assume 20%, which means we save 2 on taxes, which means that net income, let me adjust this here. Net income only goes down by only goes down by 8. And then that net income rolls over to the top of the cash flow statement. So this goes down by 8. And then what also is adjusted? Well, depreciation expense goes up by 10, which means that cash flows from operations are impacted by 2, which means that the net change in cash and ending cash balance are positive by 2. And then the ending cash balance is positive by 2. What other account is impacted here on the balance sheet? What other account is impacted? Well, depreciation went up by 2, so accumulated depreciation is impacted. That's going to go down by 10, which means that, yeah, that's exactly right, which means total assets go down by 8. And how is that balanced? Well, retained earnings goes down by 8, which means that liabilities and equity go down by 8. All right. If you want to take a screenshot of this, that's fine. But if you identify just these line items, this is going to allow you to walk through these financial statements with the change in depreciation intent in less than a minute in a clear, concise, compelling way, just focusing on what happened. Now, earlier, Leon asked a question about what if we answer it more quickly, right? And Leon, I have been in interview situations to your question that you dropped into chat where I asked, okay, what if depreciation goes up by 100 million? What's the impact? And immediately they say, oh, cash goes up by 20, right? I think this is a situation where you want to demonstrate, because one other thing that we're looking for is your ability to solve problems. When we give you a problem or a project, we're not going to be able to sit over you and watch you work. So if you're able to, in a clear, concise, compelling way, also think about running out the clock a little bit because you know you're going to crush this answer. And so you soak up a minute from the interview as opposed to just 5 seconds from the interview, delivering them things that they want, a correct answer and insight into your thought process for solving problems. You're walking through the financial statements in a logical way. I think that's clear, concise, and compelling. So Leon, I think with the goal of being clear, concise, and compelling, you want to use up the time or use up the clock. I think walking through the financial statements, walking through change in financial statements, less than a minute is clear, concise, and compelling, and you use up the clock as opposed to rushing it and maybe getting something wrong or using assumptions that they may not want you. Leon, does that help you out to your question that you asked earlier in chat? Let me know. You can just drop it in chat or not. Okay, so here's the best practice answer that I would suggest that you walk through in that in less than a minute. Any questions here on this page? Any questions here? All right. Noah, thanks for the timer. Arjun, thanks for walking it through that. Damiola asks, is it okay to take notes for this type of question? I think in a situation, Damiola, what do you have next to you typically during an interview? If you think about likely you're in an interview, maybe it's on Zoom or in person, what do you have next to you? Usually it's a stack of what? Not Kleenexes, but a stack of resumes, right? And so I think like it's very acceptable during an interview if they're giving you a lot of numbers to say, hey, you know what? I enjoy solving problems. You're throwing a lot of numbers out at me. Let me write them down and make sure that I got everything straight before I start answering the question. I think that's perfectly acceptable. And if you're over Zoom, Damilola, just make sure that you show them a blank piece of paper. Say, hey, you're throwing a lot of numbers at me. I've got a blank piece of paper here. Let me jot them down. Maybe you jot them down and then show them the paper also so they don't look like you're cheating, right? Just be totally clear about that. But hey, I like solving problems. Let me make sure I've got everything straight before we start doing it. Just make sure it's clear what you're doing. And I think that's perfectly acceptable because, Damilola, what hasn't happened before is someone hasn't gotten the question correct and the interviewer gone back after all the interviews to the recruiting room and say, hey, yeah, you know what? This person got the brain teaser correct, but you know what they did? They used a piece of paper. You know, like that's just not going to happen. The other thing, if you're live in an interview and you flip over your resume and start writing it down, they're also not going to reach across the table and grab the paper from you, right? So just make it clear what's going on, and I think that's reasonable. What do you think? Does that make sense?
Thanks. It does. Yes. Thanks.
Okay, excellent. Great questions. Let's keep it moving. So on the next page, we've got another example, the solution to change in depreciation. This one uses 50, so you can see another take at it here. And then we've got different types of analyses. Most of these you can see are valuation and M&A type analyses that we're going to talk about in the next section. So here's clear, concise, and compelling responses on page 37 for a lot of the techniques we're going to talk about in the next section. Before I get into the next section, let me see if there's any questions on the prior section talking about accounting or finance, best practice answers, this idea about being clear, concise, and compelling. Okay, excellent. On page 39, this is a good page. Please do me a favor, flag this page here. Flag this page. You should definitely have responses to these high level questions. These are, said another way, high probability questions that we see pop up during our interviews. Survey, how do you value a company? What are the various methods? What's the best method? Why use one method over another? What is a public comps analysis? What's an acquisition comps? What's a DCF, and so on, LBO, M&A? Again, your response should be clear, concise, and compelling. And particularly as you get into these valuation questions, I really encourage you to think about having levels or layers to your response, And so if you think about having layers to your response, what does that mean? That means that level one, that first layer of what is public comps, what is acquisition comps, what is a DCF, you should be able to answer that question in about 20 to 30 seconds. That's it. Real tight 20, 30-second level one response. And Kelsey, what this is doing, back to our conversation on the first slide, is it's inviting a conversation. Because Kelsey, what happened a lot of times when I was interviewing people for investment banking or private equity jobs, coming from the M&A group, I interviewed many people that were also looking to go into M&A or financial sponsors or something like that. So I'd want to talk about something that was more interesting. So we'd get through some basic accounting or finance questions. And Kelsey, if they gave me a really tight level one response for what is public comps, what is acquisition comps, I would simply move on to something more interesting that we could talk about. And if you think about, to the benefit of that, it allows the interviewer to have control over the interview, but it also allows for a conversation and allows them at the end of the interview to get the impression that you don't just have depth on something, but also you have breadth across a number of subjects, that they can say at the end of the day, hey, you know what? We talked about public comps and acquisition comps, and then we dive deeper into DCF. And then with respect to M&A, talked about a transaction that she was following. Yeah, I think this person's got a solid basis on which we could build during the internship. But some of the worst interviews have been when I've asked, what is a DCF? And someone spent 8 minutes regurgitating everything they know about DCF. What that doesn't tell me is their ability to take the complex and make it sound simple, right? Can you take a DCF and explain it high level, just like you would with a management team, in 20, 30 seconds? That's what we're trying to go for. Now, let me ask you a question. Another reason why this is important. How long are interviews typically? Drop it in chat. How long are interviews? How long are interviews? Yeah, on campus, typically about 30 minutes. Investment banking interviews, typically about 30 minutes, maybe 45 minutes, depending on the bank, but they try and see as many people as possible. And so think about within that 30-minute interview, is it really 30 minutes? Not really, because usually somebody's coming in right after you. So my suggestion, if the schedule is 9 o'clock, 9:30, 10, 10:30, 11, make sure you're out of there with a few minutes to spare, because Kelsey, just like what you mentioned earlier, we want that interviewer to have time to think about and consolidate our candidacy before they go into the next person. So if you leave at 29, 30 minutes, the next person starts, they don't have a time to think about your candidacy. So you want to get out there 26, 27 minutes. If you're done with questions, really is to say, hey, you know what? I've done a lot of recruiting. I met with a number of your firm who came to campus, and I've got all my questions answered. I'm ready to go. But I would like to give you back this time, 2 to 3 minutes, to consolidate your thoughts about my candidacy and give you a little break before you head into the next person. If someone said that to me during interviews, I'd be like, this person gets it. This person understands what's going on. Good self-awareness and situational awareness. And so really, you're trying to get out of there 26, 27 minutes. And then hopefully at the end of the interview, they ask you for what? If you have any questions, right? So hopefully they give you 2 to 3 minutes for that. So maybe the interview, really that 30-minute interview is really only like 24, 25 minutes. And then what's the first question of practically every interview? You know the first question, you know what it is. Walk me through your resume. Tell me about yourself. And usually with some follow-up questions, that's 4 or 5 minutes. So now with that 30-minute interview, it's really 20 minutes of, hey, I don't know what's coming. And so imagine if you don't have clear, concise level 1 responses, for example, for these valuation questions, spending 8 minutes of that 20 minutes walking through a DCF, that's not a great use of time. So it's going to be to your benefit to think about having levels to responses. These high probability, high level questions, you should definitely have 20, 30-second responses to. And if we have time, we'll do that here in class. So you get a start, and I'll give you some best practice answers, again, time permitting. But this idea of having layers to response and that first layer being 20, 30 seconds, give me a thumbs up if that makes sense. Okay, excellent. Well, let's continue moving here. Now, I know you've gone through that valuation class previously with Training the Street, so I'm not going to touch on a few of these items in great detail, but I do want to highlight a few things. You should be able to walk from equity value to enterprise value, and it's this walk from equity value plus net debt. Remember, net debt, if you're learning this for the first time, is plus debt minus cash plus preferred plus non-controlling interest. And then once you add all those items together, you get enterprise value. Drop into chat. Can enterprise value ever be less than equity value? Drop into chat, yes or no. Can enterprise value ever be less than equity value? Yes or no? Yeah, perfect, perfect, perfect. And when is that? When cash is greater than the other capital items. When cash is greater than debt, then enterprise value is less than equity value. Many tech companies have that. Many tech companies have that. Yeah, financial institutions as well, Santiago. So just understand that enterprise value could be less if cash is great. The other thing I want to ask you about is when you trade stocks on the market, you could go to your Schwab account or TD Ameritrade account or E-Trade account and trade securities. Right now, Apple's trading at, let's say, $200 per share. When you look at buying Apple for $200 per share on the market, is Apple being traded by millions of investors worldwide based on diluted shares or based on basic shares, those basic shares that are outstanding in the market today? What is Apple stock being traded on by millions of investors? Basic shares, or is everybody calculating diluted shares? Drop it into chat. Basic or diluted? You buy a share of Apple stock for 200 bucks. Is that based on basic or diluted shares? Basic or diluted shares? Yeah, perfect. So this is why we're in class. We get a mix of basic and diluted. The correct answer is diluted. Diluted, and you can see that in the equation itself. Equity value divided by diluted shares gives you the share price. So that share price in the market is based on diluted shares. Investors, before they purchase a share of stock, want to know exactly how much ownership they're going to have. And that means taking into account diluted shares. Okay. So that question we see trips up for changers in particular. So diluted shares is what we want. Now on page 41, do me a favor, flag this page however you want, but I would encourage you to think about for that level 1 response, that clear, concise, compelling response, that level 1 response. I think this part right here, the explanation is great for that level 1 response. And then you can get into the strengths and limitations in other levels. Level 2, level 3 response, I think will cover you for the strengths and the limitations. So level 1 response, I think page 41 is a good page for you to take a look at. At a high level, I want to talk about relative value analyses and make sure that you're clear on a few items that trip up career changers. I know you had public comps and acquisition comps a few weeks ago during the other Training the Street class, so I'm not going to go into detail, but I want to make sure you understand that within a valuation multiple, there's 2 parts. On the numerator is a value metric. It could be either equity value or enterprise value. And on the denominator of valuation multiple or trading multiple is the operating metric. And what are some examples of enterprise value multiples? Drop in the chat. What are some examples of enterprise value multiples? Enterprise value multiples. Yeah, exactly. Enterprise value to revenue. Enterprise value to EBITDA, for example. Enterprise value to EBIT. Perfect. Now, what are some examples of equity value multiples? Equity value multiples. Equity value multiples. Yeah, probably the most famous one, PE. Absolutely. Or price to book. Notice that the difference here is that the denominator, revenue, EBITDA, EBIT, is above interest expense on the income statement. And once you take out debt, when you go from enterprise value to equity value, you take out interest income, and that gets you down to price to earnings or price to book, interest income, interest expense. So the primary difference between these two, equity value, enterprise value, is the metrics above interest expense are enterprise value because they include debt. Below interest expense, they are equity value because you've taken out that interest expense. All right, one thing that we see trips up career changers. Let me ask you a challenge question here that we see in our interview prep survey. What if they give you a metric like sometimes industries are valued like in the telecom space or the hotel space or oil and gas space? Oil and gas is valued per drill holes or oil reserves. In the hotel space, it's value per hotel room or beds, or sometimes they call it doors. In the telecom space, think AT&T, Verizon, sometimes it's value to subscriber, right? What's the correct multiple? Enterprise value to subscriber or equity value to subscriber? Drop that in chat. Enterprise value to subscriber or equity value to subscriber? Drop that in chat. Yeah, enterprise value to subscriber. And here's how I think about it. Subscribers generate what on the income statement? Subscribers generate revenues. And so it's going to be enterprise value to subscriber, just like it's enterprise value to revenue. Now, before the break, which we're going to take here in about 10 minutes, I want to talk at a high level about a discounted cash flow analysis. But let me give you, before we break, so here's an output you've seen. Go to page 46, please. Go to page 46. And here's why I'm focused on page 46. Because I think this is a good summary. If you're asked about what is a public comps analysis, I would break down the level 1 response. I would include these items here, those top 2, and then also the bottom 2 items, the whole reason to perform a public comps analysis. So I think this is probably great for the level 1 response. I think down here, the bottom 2 is also good for the level 1 response. And then in here, if you're asked follow-up questions, this could show depth in level 2, level 3. Those are the type of items that I would break it down. So when I'm asked about public comps, here's a page I would use: similar companies at a specific point in time. Why am I doing it? Understand one company trading at a premium or discount, and imply the multiple range for the company that I'm valuing. All right. Let's talk about acquisition comps also. So here's an output from acquisition comps. You saw that in our valuation class. Here's how I would think about that level 1 response. So I would include the top 2 items here again, and I would include the bottom 2 items here in your level 1 response. So I think that this is good information for level 1. I think down here, wrapping up with the reason why you perform an analysis is great here for level 1. And then all these middle areas, I think this could be used in follow-up for other questions or additional questions, level 2, level 3. Okay, and then we get into intrinsic value. Now, what I'd like to do, we've been going about 70 minutes or so. I want to take a quick break. When we come back from the break, we're going to talk about intrinsic value, but we're going to talk about additional topics that you didn't cover in the Training the Street session previously. So we're going to cover new topics on intrinsic value, particularly around the challenge from our interview prep survey, around the challenging questions that we see in our survey covering DCF topics. I'll talk about those. Also, after the break, I'm going to talk about LBO math. What's some LBO back of the envelope math that's been asked during interviews that you should definitely make sure you understand. Also, we're going to talk about M&A interview math. How can you deal with a handful of key values? How can you do some quick and dirty M&A analysis? Those are items that we're going to cover after the break. I'm happy to stick around for questions, but let me give you a short break right now. Let's come back at 10:25. Let's come back at 10:25. That's about 12 minutes. 10:25, we'll come back and go into some of the more challenging DCF questions that we see during our interview survey, and then get into some LBO math and some M&A interview math as well. All right, I'll see you at 10:25 in about 12 minutes here. Happy to take any questions in the meantime. All right, welcome back. Welcome back. As we come back from break, if you're able to turn on your camera, that's, again, having that on is really helpful for me as your instructor to have that real-time feedback. So as you come back, if you're able to turn on your camera, that's much appreciated. Thank you so much to those that have done that. All right, let's talk about DCF. Here's the plan for the rest of the session. I'm going to talk about DCF. I'll do a quick debrief or brief review of what you've seen previously, real quick, and then we'll get into some of the more challenging questions that come up during interviews, topics and ideas that weren't discussed in the prior TTS valuation session. And then we're going to get into, probably after the next break, the LBO math and M&A math to make sure that you're able to handle some of those more challenging questions. So when I talk about a DCF, again, just quick review right here before we dive into some of the details. If I write this TVM, drop into chat, what does that mean to you, please? What does that mean to you? Oh, this is great. So many people have their cameras on. Thank you so much for that. Yeah, exactly. Time value of money, right? Time value of money. And what is that time value of money? It's this idea that I can figure the future value of an asset starting with its present value plus 1 plus some rate to the power of time, right? And so if I have $1 right now and I invest that at, let's say, 10% for 1 year, what do I have in 1 year? $1.10. We can all figure that out in our heads. And so what does that mean? This time value of money idea is this concept where $1 today is worth more than $1 tomorrow. Why? Because I can take that dollar today and invest it so that it grows to be more than $1 in the future. And we see that right here. Now, we can rearrange this equation. So let's do that. Present value, future value, divided by 1 plus some discount rate to the power of time. And let's turn around the same example. So let's say in 1 year, you receive $1.10. You discount that $1.10 at appropriate discount rate for 1 year. And what do you get? What's the present value of $1.10 discounted back at 10% for 1 year? Well, it's $1, right? And so we just proved that you can go either way in this time value of money, that $1 today is worth more than $1 tomorrow because you can invest it. Now, why am I talking about this before I discuss a DCF? Because if you understand this idea that if you know you're going to get an amount of money, a cash flow in the future, you can discount it back to figure out the present value. That idea of discounting is the essence of a DCF analysis. I'm going to discount the cash flow from year 1 to the cash flow to year 2 to the cash flow in year 3. I'm going to discount those all back to today. And then once I add up all the present value of the cash flows from my DCF analysis, I'm going to add them together to get the enterprise value of the firm. So to understand a DCF, if you understand this time value of money equation, then you have the essence of a DCF all ready to go. And there's just a few nuance that we can add on top of that, okay? But hopefully you feel good about this idea. Hey, I understand a DCF because I understand time value of money. If that's true, then you've got it. When we're talking about a DCF, there's layers that we've been discussing about your responses. And here we laid out how we think about different layers based on what we see. So level 1, level 2, level 3, level 4, we're going to focus on the level 4, particularly the finer points of a DCF. And before we get there, we should know that in theory and practice, the DCF says the company should be worth the sum of the present value of its future unlevered free cash flows. And just like we described in time value of money, we can see that we're taking the present value, we're discounting cash flow 1, 2, 3, 4, 5, and the terminal period after the annual projections back to the present value. If you're thinking about that level 1 response, I think this is probably a good page for that level one, what is a DCF analysis, 20, 30-second response. But let's get into some of the nuances and key points that trip career changers up during an interview. When I come to page 52, so what do we know? We know that we have a future value. We know we have multiple future values. We know we have to think about a discount rate to get to the present value. The key thing I want to share with you is that that discount rate, that cost of capital equals the expected return of the investor. Excuse me. So we know that the cost of capital, or if we're going to use a discount rate with cash flows, the one, if you're writing things down, this is definitely one I'd write down. The discount rate should be appropriate for the riskiness of the cash flows. And in a DCF, what type of cash flows do we have? Unlevered free cash flows. And unlevered free cash flows are those cash flows irrespective of capital structure. So the risk of unlevered free cash flows is associated with the risk of debt and the risk of equity. So first principles, the discount rate should be appropriate for the riskiness of the cash flows. In most DCFs, we're looking at unlevered free cash flows, which means that those cash flows are risked by both debt and equity. The other thing that you should be aware of is this idea here. The cost of capital equals the expected return of the investor. Think about that for a second. How is that possible, really? Like, how on one hand can you say the cost of debt capital to the company equals the required rate of return of the debt investor on the other hand? Like, those are two different entities, the investor and the company. How are you able to say that the cost of debt capital to the company equals the expected return to the debt investor? Well, let's think about that. Imagine you're at a lending institution, maybe a commercial bank or a credit hedge fund or an insurance company. And an enterprise comes to you and says, hey, I want to borrow $1 billion. What are you going to do? You're going to take their financial statements. You're going to project them out. You're going to do some sort of cash flow analysis, looking at their solvency profile, their liquidity to service the debt, and their adequacy to generate enough cash flows to pay back the debt. You're going to take all that information and determine a credit profile that would lead to a credit rating. And in return, you would go back to that company and say, hey, I'm willing to lend you $1 billion, but to compensate me for the risk of loaning you $1 billion, I require a rate of return of 8%. Now drop into chat. If the debt investor to initiate that loan requires a return of 8% per year, what is the cost of debt capital to the company on a pre-tax basis? Drop it into chat. The debt investor, after doing their credit analysis, requires 8%. Yeah, Kelsey, Noah, that's exactly right. It's not a trick question. If the deal's going to get done and the lender, debt investor requires 8%, then the company's cost of debt capital is 8% on a pre-tax basis. So we just proved that out. But that's a little more difficult to see for the cost of equity. There's not a yield to maturity in the market for cost of equity. So how do we determine the cost of equity capital of the company? Well, if we know the expected return of the equity investor, then I can look at the cost of equity capital of the company. And so we can figure out the required rate of return to the equity investor using the capital asset pricing model. And we'll get there in a few slides. But the third thing I want you to understand here, so the first thing was that the discount rate should be appropriate for the riskiness of the cash flows, unlevered free cash flows, cost of debt, cost of equity, and the cost of capital equals the expected rate of return of the investor. The other thing you should understand is that every company has two primary types of risk. What are they? One, business risk, and two, financial risk. And it's important to understand when you're talking about a DCF, where business risk and financial risk shows up in that type of analysis. And first, let's define what these are, business risk and financial risk. If I look on page 53, I can see that business risk is a function of the country in which they operate, those regulatory dynamics, the industry, competition, competitor analysis, competitive dynamics, for example, profitability. Are you a price setter or a price taker? Do you have pricing power, right? All those ideas are comprised in business risk. Contrast that with financial risk, which is not only taking a look at the company's accounting controls and governance, but also the liquidity and solvency profile of their company, the adequacy to pay down debt, the capital structure, the coverage ratio. Those are the components of financial risk. And what you'll see is that you balance these business risk and financial risk to determine the cost of capital. And let me share one thing with you, because a lot of people aren't thinking about it like this. So let me share this with you. Let me say, for example, can you make believe that this is a teeter-totter for a second? Let me draw this out. It's going to look like my niece drew it, but bear with me. Can you believe this is a teeter-totter? Actually, that's coming out pretty good. On one side, you've got business risk. On the other side, you've got financial risk. And every company has these two types of risk, business risk and financial risk. Now, we're going to talk about an LBO in a second, but what do you know about an LBO? An LBO uses an awful lot of what? In an LBO, you put on awful lot of what? The private equity firm. Yes, exactly right. Debt, leverage. So I'd love your help for this in chat. We got this teeter-totter. What's the financial risk of an LBO candidate, a company that has a lot of debt, that has high leverage? That financial risk of that LBO is high, medium, or low financial risk. High, medium, or low financial risk. Drop it in the chat. LBO, high, medium, or low? Yes, perfect, high. Now, think about this. What are the qualities of an ideal LBO candidate? Also, a high level question, also a high probability question. What are the ideal qualities of an LBO? Pretend you're answering that in an interview. Drop in some key phrases or words into chat. What would you say during interview? Qualities of an LBO, ideal LBO candidate. What? Yeah, Zachary, that's perfect. Stable cash flows. What else? Stable cash flows. Steady cash flows, Leon. Love it. What are the characteristics of an LBO candidate? Yeah, Henry, enough cash to cover the interest. Yep, you got to service that debt. Leon, buy cheap, right? Leon, let's say appropriate given the risk, appropriate valuation given the risks. Santiago, I'm actually going to take the other side of that and say low growth expectations. Santiago, growth costs money, right? Growth costs money in terms of maybe immediate expensing or investments in working capital or CapEx, or I've got to buy that growth. So Santiago, typically in an LBO, we're looking for low, moderate growth. Maybe I've already done those investments. So stable, mature, practically boring industries, moderate growth where I don't have to continue with large reinvestments. Santiago, let me know if that idea makes sense there. Yeah, large fixed assets to reduce the cost of that debt, liquid market, right? So you all described the qualities of an ideal LBO candidate: stable, predictable industry, large, stable, predictable cash flows, low drains on those cash flows, low CapEx, low product development, low marketing costs. It basically is just siphoning off the investments that it's done from cash. So drop into chat, what is the business risk of a company that's in a stable, mature market with predictable, steady cash flows and low drains on that cash flows? What's the business risk of that type of company? High, medium, or low? High, medium, or low business risk? Yes. Kelsey, I like that. Leon, Caitlin, exactly right. Low business risk. So team, can you see how that teeter-totter works for an LBO? You're balancing high financial risk with low business risk. That teeter-totter can work, okay? Let's look on the other side of the spectrum. How about a startup company? Maybe a new technology company developing AI for a niche market, or a biotech company developing a new vaccine for a niche market. What's the business risk associated with that startup company, high, medium, or low business risk for that startup. High, medium, or low business risk. Yes, yes. High business risk for that startup. And let's think about how startups are funded. So you can fund a company with debt or equity. How are most startups funded? Typically with equity, right? And what's some differences between debt and equity? Well, equity, there's no annual interest cost to it, right? No servicing. What is some of the differences between debt and equity? Equity, there's no maturity with equity. There's no promise to repay with equity. So equity, no annual cost to it, no promise to repay, more maturity. Equity is considered permanent capital, right? What's the financial risk of 100% equity funded startup? What's the financial risk? High, medium, or low financial risk? High, medium, or low financial risk of 100% equity funded startup. High, medium, or low? What's their chance of bankruptcy? 100% equity. High, medium, or low? What's their chance of financial risk with 100% equity? Yeah. No annual cost, no promise to repay, no maturity. Typically low financial risk. High business risk, but low financial risk. So how does a startup balance that? It balances high business risk with low financial risk. That teeter-totter can work. Where we see things don't work in this distinction between business risk and financial risk is, one of my friends shared this with me. She's a director in credit research at TIA, Kraft, a large insurance company. And she follows about a dozen credits and tracks the economy. And what she said is when she feels the economy contracting, interest rates going up, she looks at all of her portfolio for the companies with high business risk and a high financial risk, i.e. when that teeter-totter has been broken. High business risk, high financial risk. Because what she's found is those companies tend to go bankrupt during a contraction in the economy. High business risk with high financial risk doesn't work out long term. And then from an equity perspective, we see companies with low business risk and low financial risk. They tend to be the laggards. They underperform in the industry. They're the fourth, fifth, sixth player in an industry because management hasn't optimized their capital structure relative to the business risk that they've done. So hopefully this gives you a different view of balancing business risk and financial risk. And every analysis, every valuation that you do, every model that you build, keep in the back of your mind this interplay between business risk and financial risk. It's going to help you identify successful investments that are sustainable over the long term. And we can see how this is used for credit research, S&P, Moody's, Fitch, for example, by looking at, we can see for financial risk, typically the break point is around 4 times, tends to be high yield in nature, non-investment grade in nature. Above less than 4 times is investment grade. But usually what they look at is a matrix of business risk relative to financial risks to come up with their credit rating. So what determines cost of capital? The company's mix of business risk and financial risk, just like we described. And so typically we see that break between investment grade and non-investment grade is right here. So high yield tends to be on this side. Look at the mix between business risk and financial risk versus investment grade, and look at that mix of business risk to financial risk. Okay. So the mix of risk, business risk and financial risk determines the cost of capital. That's easy to see for ratings and cost of debt. And we'll see in a second how business risk and financial risk plays in to determine also the cost of equity. Give me a thumbs up if this interplay between business risk and financial risk makes sense. Does this make sense? Okay, excellent, excellent. Okay, let's continue working here on the cost of debt. One thing you should know, we've got the weighted average cost of capital. We talked about this. The cost of capital is equal to the expected return of the investor. We'll talk more about that for the cost of debt and equity. We also talked about that the discount rate for unlevered free cash flows should be appropriate for the risk of the asset. So that's why we're using weighted average cost of capital. This cost of debt is on an after-tax basis. This cost of debt, where do you get it? Is it the interest rate on current debt? Is it the interest expense divided by the debt on the balance sheet? Is it the yield to maturity of debt on the market? How would you calculate the cost of debt? Where would you get the cost of debt? Is it the interest rate on the latest debt outstanding, the coupon? Is it the interest expense divided by the debt on the balance sheet? Is it the yield to maturity? Where would you get this cost of debt for a company in a DCF analysis? I gave you 3 choices. Where would you get it? Would you look at the coupon of outstanding debt, the interest expense on outstanding debt? Would you look at the interest expense on the income statement divided by the total amount of debt on the balance sheet? Or third, would you look at the yield to maturity in the market? The yield to maturity in the market. What would you use? What would you use? Arjun, of those 3 choices, you said yield to maturity. Arjun, what is yield to maturity and why would you use that, please?
I guess like it's the actual market rate, not just the interest rate, which may not be reflective of the market in the moment. And the company would have to go with the market rate when you're considering their actual cost of debt.
Yeah, absolutely. And so notice that yield to maturity, and Arjun, just to be clear, that's if the investor purchases the debt today, that's the yield that they expect, right, to receive.
Yep.
Right. And that may
Yeah.
be different than the investor that initially let the company maybe 3 or 4 years ago when they issued that debt, right? The yield to maturity could change. And so let me ask you this. This is the market rate. Excuse me. And so this yield to maturity, is that the historical rate or is that a forward-looking rate such that if an investor purchases it today, that's what they're going to get in the future on a forward-looking basis? Is that yield to maturity, is that historical or forward-looking in nature?
If you're asking me forward-looking.
Yeah, forward-looking. So we're going to take that into account. Make notes of these items here. People, you're looking at the yield to maturity, Arjun, just like you said, the yield to maturity, you want that market-based rate, not the historical rate. And that market rate is forward-looking in nature. If you buy it, then that's the rate that you get if you hold it into maturity. So that's the cost of debt. And remember, it's on an after-tax basis. On page 55, we can see the cost of equity, and we can observe the yield to maturity for the cost of equity. But what do we do know? We do know that the cost of equity capital equals the expected return to the equity investor. And so for the expected return of the equity investor, we use CAPM. And what does CAPM stand for? CAPM stands for the capital asset pricing model. And what does it give us? It gives us the expected return to the equity investor. So that's why we can use it. We can't observe, there's no yield to maturity for the cost of equity. So we have to calculate the cost of equity capital based on the expected return to the equity investor using the CAPM, the capital asset pricing model. And there's a few things, hopefully, as practitioners, we don't need to understand all the academics behind it. There's a lot of research. You can spend an entire semester in university looking at the CAPM and the calculations behind it. But fortunately, as practitioners, we just need to know how to use it. So if we're looking here, we've got the risk-free rate, the 10-year treasury, or the 20-year, 10 to 20-year treasury. And then notice there's a couple components. One, we start off with the risk-free rate, but we're not discounting cash flows from the government. So we're discounting cash flows from a company. So we're looking at its equity. So we can't just use the risk-free rate. We have to gross up that risk-free rate by the return of equities, the market, the stock market, and drop in the chat. In the US, what's the market that we use? In the US, what's the market that we use? What's the index for the market? Index for the market? Yeah, the S&P 500. So we're analyzing an individual company. We're looking at that equity. And so we look at, well, what's the return of the market relative to that risk-free rate? That's the second component. But again, we're not discounting the cash flows from the S&P 500. We're doing the cash flow from an individual company. And so we have to look at the sensitivity of that company relative to the market, which is the beta. So beta measures the risk or the volatility of a stock relative to the market. So there's really three components of CAPM. One, the risk-free rate. Two, because we're analyzing equity, the additional spread on the market. And then three, the volatility of the stock that we're analyzing relative to the market. Relative to the market. And Arjun, help me out here. This risk-free rate, the 10-year treasury, is that the historical rate or the market rate? What do we want here?
That should be the market rate.
Yeah. So again, we want the market rate. And just like we were talking about for the yield to maturity, is that the historical rate or the forward-looking rate for that 10-year treasury? Historical or forward-looking rate?
Forward-looking in this case, or like I guess day of current.
Yeah, forward-looking in nature. But the point here, Arjun, it's forward-looking because if I buy that treasury bond today, that's the rate that I get that if I hold on to it for the next 10 years, right?
Oh, from that viewpoint, yeah, that's correct.
Yeah. And then how about the market risk premium? The return of the market less the risk-free rate. Is this historical or market? Ideally, is this the historical or market return less the risk-free rate? Historical or market?
Well, not the risk premium, but the return on equities, I think would have to be historical. Because you can't really predict that. But then with the risk-free rate, that's a market rate. So could you call it like a combination?
Yeah, there are actually a number of ways you can estimate the return on the market. So one way to do that at JP Morgan, we did the dividend discount model, for example. And so ideally, this changes, but some people use historical, but ideally, and this is why I said ideally here, Arjun, ideally you should look at the market rate, which means that it's going to be what? Historical or forward-looking? Again, it should be
Forward-looking.
forward-looking, ideally. Some people fall back to historical, but we want ideal. What ideally should you do if you had the information available?
Yep.
All right, so there we go. Now what I'd like to do on the next page is talk a little bit more about CAPM, specifically one component, beta, of CAPM. So let's flip over to the next page. And a few things we know. We know that beta measures the volatility or sensitivity of an individual stock to the market. And it's the regression, that correlation coefficient between the stock prices over the last 3 years or 5 years historically relative to the market. If you regress the market stock prices over the last 5 years to the market stock prices over the last 5 years, you're going to get a regression coefficient of 1, right? But you could have betas that are less than 1. Drop into chat. Which type of companies or industries have betas less than 1 typically? Drop into chat. Yeah, utilities, telecom, more mature companies, late stage companies, also companies with a lot of cash. Apple, infrastructure, Henry, I like that. Apple has a beta less than 1 because they have so much cash. Healthcare, Teresa, healthcare, depending on what sector. Yeah, legacy healthcare, hospitals, and so on. Absolutely. Newer healthcare services tend to be over 1. How about a beta greater than 1? Companies more volatile than the market. What type of companies, industries tend to have a beta greater than 1? Yeah, REITs, Leon, highly cyclical. Kelsey, that's spot on. Tech, high growth. Company startups, earlier stage companies. Saskia, that's exactly right. Biotech, yeah, oil and gas, highly cyclical. Zachary, GameStop, I think that's an understatement. Absolutely. Biopharma, perfect. All right, so we understand beta, right? We understand beta. Now, here's the components. We were talking about a moment ago, this interplay between business risk and financial risk. And if I look at a company, specifically, I want the business risk, that alone has a beta. The business risk is represented by the asset, what we call the asset, or unlevered beta. If I have a beta with both business and financial risk. So again, just business risk. If I'm looking at a beta that's just an asset beta or unlevered beta, that is looking at just business risk. But if I look at a beta that incorporates both business risk and financial risk, drop into chat what type of beta incorporates both business risk and financial risk. It's not an asset beta, it's a it's an equity beta or levered beta. So you've now been shown the differences. An asset or unlevered beta is business risk. An equity or levered beta incorporates both business risk and equity risk. Now, this is important. In a DCF analysis, we were talking about the capital asset pricing model to get the expected return to the equity investor. What beta is used? An asset beta or equity beta? Unlevered beta or levered beta? What beta is used in the CAPM determine the cost of equity capital? Levered or unlevered? Levered or unlevered beta? Yeah, this is perfect. We're getting a mix of answers, which is why we're doing this in training. This is a levered beta. This is a levered beta. So this beta right here, this is a levered beta. And why is it levered? Because how are we using at it? Arjun, we'll get into that in just a moment, actually. We're headed right there. Now, how is this beta being used? The beta is being used to get the cost of equity or the expected return to the equity investor. So yes, we want an equity beta. I want an equity beta to help tell me what the expected return to the equity investor is, which will help define the cost of equity. So I want an equity beta. That's what we want. And so there's questions when you're looking at equity beta or levered beta, there's some decisions you need to make. One, you can calculate it yourself. That's fine. Or get it from a third party like Bloomberg or Barra. The other decision that you need to make, so two decisions. The other decision that you need to make is, are you going to use a historical beta or predicted beta? Now, this is what I want you to know for interviews. This wasn't discussed in the previous Training the Street class, but for interviews, these advanced topics come up. Advanced topics around the beta in a CAPM is a levered beta. You can use a calculation or a third-party database, that's fine. But this distinction is really important. Do you use historical beta or predicted beta? Well, here's what you need to do. Please make a note of this. If you use a historical beta to calculate the capital asset pricing model cost of equity, then what you're required to do is strip out the effect of leverage. If you take out financial risk from the beta, drop into chat. If you take out financial risk of the beta, what risk are you left with? Or what type of beta are you left with? Yes, 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 yes. You're left with an asset beta, an unlevered beta. And you have unlevered beta for each of the companies in your comp set. So you're going to take the average of all those unlevered betas. And when you take the average, what did we say business risk was? We said business risk was what? A primary component of business risk was the risk of the industry, the competitive dynamics of the industry. So I'm left with an asset beta, which measures business risk, which means the biggest component of that is industry risk. So when I take the average of all the unlevered betas, essentially I get what we call in the industry an industry beta, an industry beta. I've taken the average of all the individual betas from my comp set, and I get an industry beta. And then the next step is we know in my CAPM analysis, I don't use an asset beta, I use an equity beta. So from the asset beta, I need to add back in leverage to get a relevered beta. Right? Let's see this process for historical beta on page 57. Page 57 has this part right here blown out a little bit more. So let's look at page 57 and I'll give you the steps. One, in your public comp set, you're going to find all the levered betas. The second step, so we're unlevering, relevering the beta. The second step is you're going to unlever, exclude the part of the beta with leverage, and you can do that with this formula. For interviews, a lot of people have asked, I would not suggest that you memorize this, just understand conceptually what's happening. All right, just understand conceptually, and I'm giving you what conceptually. I'm breaking it down for you. Just understand these 4 pieces, okay? 1, you're going to find the levered betas for the comp set. 2, you're going to take out the financial leverage of those betas. So now you're down to unlevered betas for each of the comps. You're going to take the 3, you're going to take the average or the mean, which means this is where you get the industry beta. And then the last item here, because the CAPM uses an equity beta, I've got to relever it. That's the 4th step. Relever it. And then Arjun, to your question about capital structure, relever it at the capital structure for the company that you're valuing. And here's the process to relevel. So here's what I want you to think about. I'm happy to take questions on this. If you're asked in an interview, which we see come up quite a bit around unlevering, relevering betas, this is the what? This is the process to unlever, relever beta for use in the CAPM, the cost of equity. But more important than what, I want you to understand why. For interviews, I want you to take it up a notch and understand not only what the process is, so that if you are on the job, you could duplicate this 4-step process, but also I want you to understand why. I'm going to take questions on what, and then we'll get you to why, so you can go in depth during your interviews. So first, let me take questions on what? The 4-step process to unlever, relever beta for use in CAPM. Okay, I don't see any questions on the what, the 4-step process that we outlined here. So let me ask you this question. Why do we do this? This sounds pretty painful, right? I've got to find all the levered betas for the comps. I've got to unlever all of those comps. Maybe there's like 10, 12 comps. I've got to unlever each of the betas of those comps. Then I've got to take the average, get the industry beta. And then I get right back to where I started. I relever that asset industry beta. I relever it, and then I can use it in my CAPM. Leon said, compare apples to apples. Absolutely. I want to compare apples to apples. Sure. Yeah, our June called out that each company has their own capital structure. Absolutely. Yeah, Henry, because the target capital structure is different than each company's capital structure. Each firm has a different capital structure. That's right. That's right. That's right. All that's spot on, but there's another piece to this. There's another piece to this. If all those thoughts about capital structure is correct, why don't I just, to that point, Akash and Henry, to that point, why don't I just use, if I get back to a levered beta, if I get back to an equity beta, if I get back to an equity levered beta, then why don't I just use the company's historical beta? Why do I go through this process of unlevering, relevering, industry average, only to relever back to a levered beta? Why don't I just use the company's historical beta? I get back to an equity beta. Why don't I just use it? Yeah, Sylvia, that works for a private company. Let's talk about a public company. Why don't I just use the public companies? Oh, Kelsey. Kelsey, that's a gold mine right there. Kelsey, can you unmute?
Yes, I can.
Everyone, yeah, Luis, this is everyone, this is the why. So we talked about the what. And Kelsey got us to the why. And Kelsey, Arjun and I talked about this. Remind us, this yield to maturity for debt, Kelsey, is this a historical or forward-looking?
Forward looking.
Forward-looking. For the cost of equity, is this risk-free rate historical or forward-looking?
Forward looking.
This market risk premium, is that historical or forward-looking?
Forward looking.
So ideally, the beta should also be
Forward looking.
forward-looking. And Kelsey, to wrap it all up, the cash flows that we're discounting, are they historical or?
They are forward looking.
Yes, that's exactly right. I love the enthusiasm, Kelsey. Thank you so much for that. But that's the reason why, team, is because we have these forward-looking cash flows. We have forward-looking discount rates that should be appropriate for the riskiness of those cash flows. And Kelsey, this is why I was very specific that if I said you're using a historical beta, then you've got to go through that unlevering, relevering process to get that forward-looking beta. That's the purpose. We're trying to get a forward-looking beta, forward-looking in nature. And so, Kelsey, what happens here is that the capital structure, there's a few ways to think about the capital structure that you re-lever it at. Obviously, Kelsey, it's not going to be the capital structure historically from 5 years ago. It's typically the current capital structure because that's at the time of the analysis. Or Kelsey, the other thing is the capital structure that was used to create the cash flows. I like that because then I have symmetry between the capital structure that used to create the cash flows that I'm discounting. Or the third way, Kelsey, is people just use an industry average capital structure because they know in the forward-looking future, you're going to get to that industry capital structure anyway. So 3 options, perfectly acceptable. The current capital structure, the capital structure used to generate the cash flows, or the industry capital structure. But either way, Kelsey, to the point, the why we do this process of unlevering, relevering is to get a forward-looking beta, which helps us calculate a forward-looking cost of equity, which we use with a forward-looking cost of debt to discount forward-looking cash flows. Yeah, that's the why. Nice job, Kelsey. Luis, I saw you also had that in chat. Everyone, let's give it up for Kelsey and Luis. Well done. Why do we do this? We want the forward looking. Kelsey, what do you think? Does that make sense? We not only went through some advanced concepts about why we do it, unlevering, relevering, also the what, but also the why. What do you think, Kelsey? Any questions there?
No, that makes sense to me.
Okay, awesome. Let me see if there's any questions from the group. Again, Kelsey, you're crushing it today. Thank you for your help. Okay, excellent. So now you've got the what as well as the why, so you can show depth and nuance during your interviews. That's exactly what we're looking for. Well done, Luis and Kelsey. Give me your quick response to, in a DCF, walk down to unlevered free cash flows. This could take you 30 seconds. Stay on mute, but play full out with me today. Go ahead and do this on your own. You're asked to interview, walk down to unlevered free cash flows. What would you say? 30 seconds, ready, go. Okay, that's 30 seconds. The goal during the interview is make the complex sound simple. Let me give you my best practice answer to this. Walk down to unlevered free cash flows. And I'm actually going to use page 59. So let's page over to page 59, please. So we have a DCF. You can see that we go out 5 years. And let me put a bracket around the top part of a DCF. Do me a favor, please. Drop in a chat. The top part of a DCF looks like which core financial statement? The top part of a DCF looks like which core financial statement? Oh yeah, smart, smart. The income statement, exactly right. Exactly right. Top part of a DCF looks like the income statement, but there's a key line item missing from a DCF view. What is it? What's the line item missing? What's the line item missing from a DCF view? Louise, COGS is implied. That's how we get to EBITDA. Oh, Leon, spot on. Leon Daviel, that's exactly right. Does everybody see that? Interest is missing. There's no interest. And Leon, why is there no interest expense here? Why is there no interest expense here, Leon?
Because we're calculating the unleveraged free cash flow.
Yes, team, that's exactly right. Nice job, Leon. You're calculating unlevered free cash flows. And what are unlevered free cash flows? They're the cash flows available to both debt and equity. So I couldn't have paid out anything to debt holders in the form of interest if I'm trying to calculate unlevered free cash flows, which are all the cash flows available to both debt and equity. All right, so that's why. So DCF top part looks like the income statement. What if I put brackets around the bottom part? The bottom part looks like which core financial statement? Drop it in chat. The bottom part. Yes, yes. Saskia, that's exactly right. The cash flow statements. We know there's a few sections on the cash flow statements. Depreciation, amortization, which section? Operating, investing, or financing? CFO, CFI, CFF. Depreciation, amortization. Yeah, exactly right. Operating. Changes in deferred taxes, O, I, or F. Changes in deferred taxes. Yeah, typically this is operating. CapEx, additions to intangibles. Which sections? CapEx, addition to intangibles. Yeah, Leon, spot on. Arjun, nice. Investing. Changes in working capital. Which section? O, I, or F? Yep, operating. And change in other assets and liabilities. Long-term assets, long-term liabilities. O, I, or F. Yeah, this is operating as well. So what's missing? There's no cash flow from financing. There's no cash flow from my financing. And as Leon told us, why? Because we're trying to get to unlevered free cash flows. So what I would say in the walk down to unlevered free cash flow question, I would say I'm going to start with the income statement, get down to EBIT and tax effect EBIT, excluding interest expense. Then below tax affected EBIT, I'm going to adjust for all the cash related items from the operating section and investing section, like depreciation, amortization, changes in deferred taxes or working capital or other assets, as well as taking into account CapEx and purchase of intangibles in order to arrive at unlevered free cash flows. That's my walkthrough, 20, 30 seconds. I think you got it there. And then you allow yourself to open up for questions. All right. Any questions here? Okay, let's continue moving. The rest of this in this DCF section, terminal value, you're familiar with this. Remember, you should know 2 ways to calculate property growth, exit multiple. This was given to you as a review. What type of multiple is this? A lot of career changers get this tripped up. What type of multiple is this in the exit multiple method? Yes, exactly. Enterprise value, So it's the total enterprise value to EBITDA multiple. You multiply it by EBITDA, which means this gets you enterprise value, which you then discount back the same number of years as the last year of the projections. And which type of analysis is it? The exit multiple, does that come from a public comps or acquisition comps analysis? Exit multiple comes from public comps or acquisition comps. How would you answer that during an interview? Exit multiple, exit multiple, exit multiple. Yeah, exactly. Only and always public comps. And ideally, you want like a mature company multiple. Because at that point of the DCF, you're at maturity. The other thing, which I know you've seen for completeness, that growth rate is typically bounded by inflation on one side and the country GDP growth on the other, stuff that you've seen before for a developed country that's typically 3 to 4% growth rate. The last bit in this DCF section covers a few things. Look at this. Does this make sense to you? Notice we have the perpetuity growth method on one side, the EBITDA multiple method on the other side. But how is it possible that the net present value of the free cash flows is exactly the same? Does that make sense? How is that possible? Two different methods, perpetuity growth and exit multiple. How do you come up with the exact same values for the net present value of the free cash flows? How is that exactly the same? Is that an error in this model? Is that an error? Should it be the same? Sylvia, not an error, correct? Not an error. Because everyone remember, these should be the same. Why? Because these are from the annual projections. Yeah, Henry, these are the projected years. The terminal value is different. This is where the differences start to come in. My point of highlighting this is that in a DCF walkthrough, the net present value for both perpetuity and exit multiple is going to be the same. And then when you're adding the terminal value, that's where differences could occur, but hopefully not big differences. You should still come up with a pretty similar equity value given the different methods if you're being intellectually honest, which is why on the job, you typically don't show both. You typically show one and then sense check it with the other, imply the multiple or imply the growth rate. All right, the other parts in this, I would flag page 62. This is good for that level 1 response, thinking about explaining a DCF at a high level. You're looking at the discount of the projected unlevered free cash flows with the discount of the terminal value at the weighted average cost of capital to get the enterprise value. From there, you can walk down to equity value and price per share. Next, I want to talk about affordability analyses. And before I do that, let me pause here and see if there's any questions on affordability analyses. Yeah, Haley, please.
I just had a question about the exit multiple that you use for, yeah, perfect, for in the EBITDA multiple method. Do you just use that from a comparable company like the last 12 months multiple, or what multiple, like where do you get that from?
Yeah, so this is a great question, Haley. It's silent here, but it's implied because EBITDA N, Haley, is referring to the last year of the projections. So this by definition is an LTM multiple. So typically you're using an LTM multiple. And Haley, the reason why investors use forward-looking multiples because there's differences in growth rates and so on. But when you're at the terminal period for a company that you're doing a DCF on, you're at maturity, you're at steady state. And that's defined by a few things: CapEx approximating depreciation, as well as a constant growth rate. So they're at maturity, at this terminal value calculation, there shouldn't be much difference in growth between an LTM and a forward multiple. Typically, and because of that, we typically use LTM. Now, I have, Haley, in certain circumstances where maybe it's an early stage tech company, for example, or a cyclical company, and we're not projecting them out for 10 years or 15 years, but we'll do a shorter analysis, 5 years, and then do one more year and do a forward multiple on that. But typically it's an LTM multiple based on EBITDA in the last year projections. So this multiple is also LTM from public comps. And if I'm thinking about a public comps range, Haley, and usually that range, let's say, is 10 to 12 times is what shows up from my public comps valuation on my valuation summary, 10 to 12 times. The DCF should use something at the lower end of that, like 10 times, for example, to show that you're now at a slower growth stage of that company's profile.
Awesome. Thank you.
Yeah, absolutely. Good color there. We're actually on the job. Okay, let's talk about affordability analyses. And the first thing I want to highlight here on page 64 is the difference between how an investment banker might look at free cash flow and how a private equity professional might look at free cash flow. Drop in a chat when you notice the difference. Drop in a chat when you notice the difference. Yeah, Henry, that's spot on. Yeah, Teresa, that's correct. P, firms care about the interest expense. Notice investment bankers tax affected, unlevered free cash flows. And Henry, just to be clear, this isn't a fully levered free cash flow. A fully levered cash flow, Henry, would also take out debt in addition to interest expense. So this free cash flow is like what we call cash flow available for debt service, cash flow available for debt service. So it's not totally levered cash flow. It's somewhere in between unlevered and levered. It's right there called cash flow available for debt service. And so here, notice that net income is after interest expense. Notice that if we start with EBITDA, we take out cash interest to get to that cash flow available for debt pay down. One of the key differences when you're talking about an LBO, what is an LBO analysis? Again, I think this is a great page for that level 1 response. What are the things that should be included in that level 1 response? I would say something like it's a financing technique for acquiring a company using a lot of debt and a small amount of equity. If the company's public, then this means that they're going private and is performed by financial sponsors. Now, there's another part to this. So this is, I think, what an LBO is, This down here answers the question, what is an LBO analysis? And you can fold that into the same response if you want, but an LBO analysis, because you're putting a lot of debt on the company, how do you pay down that debt? With cash. An LBO analysis focuses on the cash flow generation by the target company over the investment period. Those cash flows are used to pay down debt and service interest and provide the financial buyer with levered returns. All right, that's the goal there. Typically, these investments, they're different from strategic investments. They're over horizons of 3 to 5 years, so the private equity firm can return the money to the limited partners and then go out and raise new funds and so on. So page 65 is good to answer that quick level 1 2030 second response. What is an LBO or what is an LBO analysis at a high level here? We talked about the typical LBO structure when we were covering business risk and financial risk. So some key things you should understand. Obviously, seniority of debt is higher in the capital structure, senior debt. Oftentimes this is secured debt. And let me do this. So we answered this question already. Let me give you some additional information about page 67 on page 60, about page 66 on page 67. So you can think about that. I need a little more space. So what is an LBO candidate? We already answered that in chat when we were talking about business risk and financial risk. Let me talk about page 67. So this is page 66, capital structure, because I need some extra space. And usually this looks like this. So you have an entity, for example, and that entity can be funded with typically debt or equity. And let me help you break down the different types of debt and equity. So the most senior type of debt, these are called loans or credit facilities. If you've heard of a revolving credit facility, that's a type of loan. And oftentimes these are, not only are they senior in nature, but also they're secured, which is why private equity firms like to purchase companies with a lot of assets so they can leverage those assets or secure those assets against the loans and reduce the cost. Now, next type of debt, subordinate to these loans and credit facilities, these are called bonds or notes. So these are subordinated debt, and they're typically unsecured in nature. Now, the next piece of debt that you have is called mezzanine debt. And that's because it looks like debt. It may have an interest component. It may have a promise to repay. It may have a maturity, but also it could be converted into equity. And then we have equity, and we've got preferred stock. This usually has a coupon. So it's similar to debt in that respect. It's got an annual cost to it, but there's no maturity associated with it, no promise to repay. So you can see in that sense, it's different than net. And then finally, we've got common stock. And this is where you have the voting power in the company. Louise, it depends on to your question in chat, Louise, it would depend on the components. Could those perpetual notes be converted into equity? If so, I'd say it's probably a mezzanine. If not, it's probably more like a bond. But this is why I wanted to show this to you, because within every entity, the first level, you can fund the company with debt or equity. Within debt, you have a few choices. You can look at loans and credit facilities. Those are senior and often secured. Subordinate to that, you have bonds or notes, subordinate debt, less senior in the capital structure, unsecured, more expensive, more risky. And then we also have mezzanine debt, like a convertible bond, that has components like debt, an annual interest expense, a promise to repay, a maturity, but also could potentially be converted into equity to participate in the upside. Within equity, we have preferred stock, which actually is pretty similar to a bond. There's no voting, just like a bond. There is a coupon, just like a bond, but the reason why it's equity is because there's no maturity or promise to repay. And then underneath that, you've got common stock, which defines ownership over the voting power of that, right? Let me pause here. Hopefully this view, this tree that I drew here helps you understand page 66 a little bit better. Let me pause here and take any questions. Okay, perfect. And then for this ideas that we talked about, what makes Teresa, let's answer that question that you sent me directly. Let's answer that during chat. What makes a good LBO candidate? We talked about these ideas, strong, predictable cash flows. These are things that I'd love for you to hear say during an interview. Defensible market position, limited CapEx. With respect to undervalued or synergy opportunities, I would prefer you say something like valuation is appropriate given the risks. And what do I mean by that is if it's a distressed company, then you should get a great price for it. If it's a perfectly good company, you should pay fairly for it, but also there's less risk for you. So valuation appropriate given the risk. And then the other thing that we didn't talk about is this idea of there should be a motivated seller. The private equity firm only makes money when they sell companies that they bought. So if they're continuing to look, the sellers are saying, no, 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 they're just using up money. And then do me a favor, drop into chat. How can you exit an LBO? I'm thinking of 4 ways you can get out of an LBO. What are those 4 ways you can get out of an LBO? Drop it into chat. Yeah, perfect. Haley, that's exactly right. Sylvia, yeah. So IPO, sell to the markets, sell to strategic, sell to a sponsor, or nobody's mentioned this yet. I'll give it to you, dividend recapitalization. And let's talk about that for a second. What is a dividend recapitalization? It's basically where a private equity firm starts out and maybe they borrowed 5 times debt to EBITDA initially, 5 times leverage, debt to EBITDA. And over the next 3 years, they paid it down. Now, 3 years in, they're at 2 times debt to EBITDA. They're looking to sell the company. IPO market's not available to them. They look to sell to a strategic or sponsor, not available to them. What they can do is they can go back to the banks and say, hey, we've been running this company successfully for 3 years. We pay down our debt from 5 times to 2 times. What we'd like to do is go back up, borrow back up to 5 times, and then take out that difference as the form of a dividend to us, the equity holders. And so the banks will do another credit analysis, look at their cash flows, make sure they're able to do that, and then provide them with the additional leverage to go from 2 times back up to 5 times. The cash comes in and you're able to dividend that out as a return of capital to the private equity firms. And if you think about it, this is great. A lot of private equity firms do this, especially in the software space where they still own the company, but they got 1 times their money back from a dividend recap. That's pretty large. Usually not 100% of the capital the banks allow to get paid out. Usually it's about 70% or so. The banks like to have a little bit of cushion left in there, but they'll allow 70% to go out to the private equity firms. The other thing that I'd like you to think about, drop in a chat for me. How do LBOs create value? What would you say during an interview? How do LBOs create value? I'm thinking of 3 particular ways. How do LBOs create value? How do LBOs create value? Thinking about 3 ways in particular. Yeah, Teresa, that's perfect. Efficiency enhancement, so improving EBIT or EBITDA. Financial engineering, yeah, debt, leverage, paying that down. Ops, paying down debt, creating equity. That's exactly right, Caitlin. Zachary, yeah, that's all of them right there. So we can see here, here's the 3 things that I want you to highlight. 1, deleveraging, you're paying off debt. When you pay off debt, we know equity grows. Even if you buy and sell for the same amount, you pay down debt, equity's larger. Operating improvements. The key thing here that I want you to understand, operating improvements at the driver of value. One of my friends works in private equity for consumer product goods companies. Has anybody heard of, give me a thumbs up, has anybody heard of a hamburger shop called Shake Shack? Shake Shack, has anybody heard of Shake Shack? Yeah, so they were an early investor in Shake Shack before they went public. Has anybody heard of Bark Thins? Those little chocolate snacks, sweets, Bark Thins? Crave Jerky, a few of you, yeah. So they invest in those type of companies, and their philosophy, they look at small, medium-sized companies focus on operations and distributions and marketing really is where they come into play. And then their exit is to huge consumer product companies like Kraft or Unilever or Pepsi or Mondelez, Hershey. And I asked him, I said, what do you guys focus on? Is it EBIT? Is it EBITDA? When you're looking at operating improvements, what do you focus on? He said it's contribution margin. Why? Because where they're selling it to those large companies, Kraft, Unilever, Mondelez, and so on, they already have all the infrastructure, the distribution. They even have a lot of the manufacturing. The marketing's already done. They're just looking for that additional product to help them grow revenues inorganically over time. So that's what they focus on. So operating improvements are great, but you want to make sure you're doing it at the driver of value. What is that line? Is it revenues? Is it gross profit? Is it contribution margin? Is it EBITDA? Is it EBIT? That's where you want to make sure you're adding value. And then the last item here is multiple expansion. You buy it for 5 times, you're able to sell it for 8 times. Even if you didn't pay down any debt, you created value in that transaction. I want to talk about some LBO math, but I'm going to do this after the break. We've been going for about 70 minutes from our last time, but I'm going to give you a little bit longer break. So when we come back from the break, we're going to do 3 particular things. One, we're going to talk about LBO math on page 71. We're going to talk about M&A math. And also, I want to give you some more best practice responses. So flag page 71, but this is what I'd like you to do. We're going to have a little bit longer break, but this is what I'd like you to do. I'd like you to take a couple minutes before you take your break and answer these questions. Answer these questions right here. 1, what is a public comps analysis? What's your 20, 30-second response? I'll call on a few people to give their response. If a few people give their response, then I'll give you my best practice response on that so we can get some real-time feedback. 2, what is an acquisition comps? 3, what is DCF? And 4, since we've talked about it, what is LBO? Take a couple minutes. Develop your level 1 response. You should have responses to all of these high probability questions, but take a couple minutes just for the topics that we've discussed: public comps, acquisition comps, DCF, and LBO. What's your level 1? Just your 20, 30-second response. When we come back from break, we'll call on a few people. I'll give you some reactions and real-time responses, and then we'll get into some LBO and then M&A math, and then we'll wrap up. All right, let me do this. Let's come back at, I'll give you about 18 minutes. So that's about 8 minutes to work through your 20, 30-second response for each of these 4 questions. And then also take a 10-minute break. Let's come back at, what is that? 11:55, is that right? 11:55? Okay. Try this. I'll call on a few people when we come back. 11:55, I'll see you back here. Teresa, let me take a look at your question, then we can answer that. Here. Teresa, let me know if you'd like to chat now about your question in chat, or we can pick it up at 1 o'clock once we finish class.
Yeah, for sure, Scott. Is there any way we can just chat in the like a private chat or?
Let's see, not right now. We could do that at the end of class though. So if you want to stick around for a few minutes, it won't take that long to talk about. So if you want to just stick around for a few minutes after class, we can do that in individual.
For sure. Thanks.
Okay, sounds good. Welcome back. Welcome back. As we come back from break, there's a few things, like I mentioned, that I'd like to do in the next 65 minutes before we wrap up. We're on track to get out by 1, so no issue there. I'd like to go over some best practice responses to these level 1 questions, that 20-30-second response, if anybody's willing to do that. And then I want to get into some LBO interview math that we see comes up and trips up career changers during interviews, and also some M&A interview math that comes up as well, some advanced stuff that hasn't been covered at prior Training the Street sessions talking about corporate valuation. As you're coming back, I see many of you have. If you could turn on your cameras, that really helps me to have that real-time feedback. So thank you very much for everyone doing that and the contributions and interaction during the day. Much appreciated from my perspective. Let's pick up here on page 39 with these 4 high-level questions that I asked you to develop a quick 20-30-second response to. Let me see if there's any volunteers, and if there are some volunteers, then what I'll do on the back of that, I'll give some real-time feedback and my best practice response if we have a few people willing to volunteer. Let me see here. Anybody? The first ones to go get to choose the question. Saskia, is that how I pronounce your name?
Yeah, you're right.
Saskia, awesome. This is great. Thank you so much. Let's see. Let's, before you go, Saskia, everyone, let's give a round of Zoom reaction hand claps. Saskia, it doesn't matter, right or wrong. We don't care. We just love the contribution. Thank you very much for doing that, contributing to class. It's your moment. Just sit back and bask in the glory of the hand claps. All right, you are the first one to go. Which one would you like to do? I'll give you your choice. Any thoughts here?
Please could I try the public comparables analysis?
Yeah, perfect. Public comparables. So let me set it up for you. You're sitting in an interview. You've just gotten over, walk me through your resume. Maybe you've answered some accounting questions. We're getting to the valuation, and they say, hey, let's talk about public comps first. Saskia, what would you say is a public comps analysis? How would you answer that, please?
So I would say that public comparables analysis is a way of evaluating your own company based on other public companies that are out there based on a select amount of criteria. You would typically pick those comparable companies based on their like industry to your company, based on similar financial metrics to your company, and also potentially the geographic location that they're operating in. So as long as you have like those similarities screened, then you can use the financial metrics of those comparable companies to come up with certain multiples that would apply to your own. And you would tend to look at maybe the EBIT multiples or the like revenue multiples, for example. And out of the set of public company comparables, it's best to start with the median multiple. And apply that to your own company to get to your own valuation.
All right, perfect. Holy shit, that was good. Huh, guys? That was great. Nice work. Nice work. Let me see, before I give you some real-time feedback, Saskia, and I do have some thoughts, and I'll give you my best practice response. Let me see if anybody else, to get a variety, the acquisition comps comparable is going to be pretty close. Would anybody like to do the public comps or acquisition comps? We can compare and contrast, and then I'll give you my thoughts on that, Saskia. Let me see if there's any volunteers for public comps or acquisition comps. Those are pretty similar. Yeah, Santiago, would you like to do one of the comps or DCF or LBO? What do you think?
I can do acquisition comps.
Okay, let's do acquisition comps, and then I'll give both of you real-time feedback there.
Perfect. So for acquisition comps, you take the company you're valuing and the company you want to buy, and take comparable acquisitions in the same industry. Same was that you try to make it the same size as well, revenue size for it to be comparable, and between a time frame of the last 12 months or so, because if not, if you go too further back, it may change the valuation, and basically that would and see the multiples, see basically the acquisition multiples of what it was sold.
Okay, perfect. That was great as well. So nice job, everyone. Let's give Santiago a round of Zoom reaction hand claps. Well done, Santiago. So we have two. I'll go through the public comps and we'll see if anybody wants to do DCF or LBO. So Saskia, in terms of public comps, my best practice response, I would say something like this, then we can compare and contrast yours to mine. You'll notice there's a lot of similarities. I promise I did not steal it from yours. But I would say something like a public comps is a relative value analysis that compares similar companies across various trading multiples and operating metrics to determine whether one company is trading at a premium or discount relative to another, and imply a valuation range for the company being analyzed. And Saskia, what I like about that is notice that it's tight. It's 20, 30-second response. But also what I'm doing is setting up some other items, which are, these typically aren't professional interviewers. They're professional bankers, for example, who happen to be doing interviews because HR is not familiar with testing these technical topics during an interview. So we need a banker to do it. So they can do it. They have done it. They talk to management teams all the time, but they're not professional interviewers, which means we can use that to our advantage. Notice what I did. I used some bankers' buzzwords in there. I said public comps is a relative value analysis. Notice what else I did that was a little bit different from yours, but I said compare across various trading multiples and operating metrics, without going into detail. And the reason why I did that is because I'm trying to plant the seeds for a follow-up question. Hey, you mentioned trading multiples and operating metrics. I like your definition. Let's go deeper. What trading multiples would you use and why? What operating metrics would you use and why? Notice that I did something similar when I said a public comps is a relative value analysis that compares similar companies. Again, I'm planting the seeds. Hey, you mentioned similar companies. What makes those companies similar? And the reason why I like doing it that way, Saskia, is because what it allows me to do is then have a full answer to talk about what makes a company similar. And we know there's 8, 10, 12 different things I can mention, but having a list of 8, 10, 12 things to get across that I understand this fully and comprehensively sounds a little bit shortened when I try to put it in a really tight 20, 30-second response about what is public comps. So I plant the seeds with similar companies, leading to a potential follow-up question. I plant the seeds with various trading multiples or operating metrics, planting the seeds for follow-up questions. And then I'm trying to game the system a little bit. Since I know the interviews are a finite amount of time, can I prompt you to ask me questions that I'm going to know so it sounds like I have depth? If not, I gave you a tight 20, 30-second response and we can go on to something else. And then I like the way you wrapped up by getting at the whole reason why you perform this analysis. You want to compare whether one company is trading at a premium or discount. Multiples tell you that, stock prices don't. And to imply a valuation range for the company that being analyzed, similar to what you said. Saskia, any thoughts there on the compare, contrast yours to mine or responses there?
Yeah, I think that my response lacked some of the key terms that yours mentioned. So I think I need to make sure that I'm sort of tightened up on the specific vocab of the answer as well.
Yeah, perfect. But honestly, I've been doing this for years, dare I say decades at this point, and I think you're off to a great start. And I'm glad that you contributed to class because now you understand exactly what you want to do for yours to make it sound like a great response during an interview, which if you hadn't contributed, we wouldn't have that answer. So I'm glad that you did that and got some real-time feedback. Also, what I'll do for you, Saskia, if you'd like, go through the list of your one-time responses, and then if you want, shoot me them in an email and I'll take a quick look at them for you. So thank you. Thank you to you for contributing. I really appreciate that.
Thanks.
And then Santiago, you did acquisition comps. My answer to acquisition comps is very similar to public comps. One, it reduces what I have to learn. I just switched the phrase company and public comps to acquisition and comparable comps. Otherwise, it's the same. And that way I have to memorize less or remember less. And so mine sounds something like acquisition comps, relative value analysis that compares similar transactions across various trading multiples and operating metrics to determine whether one transaction traded at a premium or discount relative to another and imply a valuation range for the transaction being analyzed. So again, Santiago, to my comments with Saskia, I'm trying to plant the seeds for follow-up questions that I know I'm going to crush by not going into much detail on what makes the company transaction similar, for example, or what multiples or operating metrics I would look at. I've identified that they're there, and I can answer follow-up questions if you'd like. Santiago, any thoughts on compare contrast between yours and mine's there?
No, perfect. Very clear. Thank
Okay,
you so much.
excellent. Again, thank you very much, and I'll do the same thing for you. If you want to shoot me an email with your responses, happy to give you a quick markup of that. Let me see if there's anyone here to do DCF or LBO. If not too concerned. In the interest of time, I'm happy just to give you my thoughts on that. But let me see if there's anybody that would like some real-time feedback. If not, in the interest of time, I'll just give you mine. Okay, excellent. So my DCF would sound something like, again, really high level, similar to what we talked about. Back to the idea about planting the seeds, I'd say something like it's an intrinsic value analysis that discounts a company's unlevered free cash flows from both the annual projections and the terminal period back to the present using the weighted average cost of capital to derive the enterprise value of the firm. From there, I can walk down to equity value and price per share. Now, notice what I did there was I connected unlevered free cash flows to weighted average cost of capital and enterprise value to signal to the interviewer that I understand these three topics go together: unlevered free cash flows, weighted average cost of capital, and enterprise value. Notice I didn't go into how long the annual projection should be. That's a great follow-up question. Notice I didn't go into how the terminal period is calculated. I didn't get into that. Notice I didn't go into the components of the weighted average cost of capital. Why? Because I'm planting the seeds. Those are all things that are great follow-up questions that I know I'm going to crush. And then a leverage buyout analysis, I would say something like an LBO analysis is an affordability analysis that focuses on the cash flow generation of the target company over the investment period to ensure the company is able to service the interest expense and pay down the debt, providing the financial sponsor with levered returns over a time period of typically 3 to 7 years. All right, again, planting the seeds, but not too much detail in that level 1, 20, 30-second response. Let me take any questions or comments there. Otherwise, we'll go back to page 71. Okay, excellent. Again, thank you, Santiago, Saskia. That was great. Really appreciate that. Let's go back to page 71. In our remaining time, I'd like to go through some LBO interview math and some M&A interview math. Here's what I want you to think about. LBO is simply an optimization exercise. An LBO, I want you to think about an LBO as an optimization exercise between three parties. Who are those three parties? Well, one, we've got the lenders. Two, we've got the sponsor. And three, we've got the sellers. Only when those three parties are happy does an LBO deal occur. And so during an interview, I could give you three values and then ask a number of questions about it. Let's start that. Let's say, for example, the lenders have looked at the cash flow profile of the company and said, hey, we're not going to lend more than 6 times. The sponsors ran their LBO analysis looking at the cash flow generation, and in order to meet their return hurdles of 20% or higher, they're not going to contribute more than 33%. The sellers have been advised by an investment bank that told them after looking at acquisition comps not to sell for less than 10 times. My question for you to get us started is, does this deal occur? Yes or no? Drop into chat, yes or no. First, wait. Take 20 seconds. Think about it on your own. And then I'll ask for responses in 20 seconds. Does this LBO occur? Yes or no? Okay, I'd love to hear your thoughts. Does this LBO occur? Yes or no? Does this LBO occur? Yes or no? Yes or no? We've got a yes, we've got a no. Got 2 no's, 1 yes. Another no. Haley, you were the first one to say no. Let's talk about this. And everyone, I was purposely vague. Let me fill in some of the blank here for you, because they may be vague during an interview too. What is 6 times? We're talking about 6 times leverage, right? And what is leverage? Leverage is debt divided by EBITDA. Debt divided by EBITDA. And when we say 33%, what are we talking about? This is 33%, which is the initial equity contribution. And then 10 times, what is 10 times? 10 times is the what? 10 times is the transaction multiple. And here we can see that it's total enterprise value divided by EBITDA is how that's done. So Haley, if you were the first one to say no, nice job there. Henry, Jose also got that. But Haley, the first answer is no. Let me ask the second part of this question. And notice, Haley, I just gave you 3 numbers, which is pretty easy to do during an interview, right? And then we can start off a whole series of questions. So you were spot on by saying no. And then let me ask you this to answer why it's no for everyone else. What would the sponsor have to contribute for this deal to work? So Haley, the lenders are fixed at 6 times. The sellers are fixed at 10 times. What would the sponsor have to move to for this to work?
At least 40%.
Yeah, at least 40%. And how do we know that? Well, we need 10x, and the lenders are willing to give me 6x, which leaves a delta of 4x. And the capital structure, debt plus equity, equals the total amount. So 4x divided by 10x equals 40%. So if the sponsor, Haley, goes up to 40%, then this LBO is optimized. All 3 parties are happy with the terms and the deal gets done. Easy peasy, right? But Haley, this is an interview, so there's a complication, of course. And that complication is the private equity associate realized the next morning with fresh eyes that 40% does not work, Haley. And the model had to go back, and the model showed that to reach 20% or higher, they couldn't put in 40%. They had to go back to 33%. But Haley, we got a problem because the seller thought they were getting a deal done. In fact, the seller was so excited about it, Haley, that the CFO already went out and put a down payment on a yacht, right? He's going to call it the SS EBITDA, right? And so they need to get a deal done. The third part of this interview question, Haley, is the lenders are at 6, the sponsors at 33%. What do the sellers have to come down to for this deal to get done. That's the third part. Any thoughts there, Haley?
9.3.
9.3, close. Let's go ahead and lay this out for everyone here. So we've got the total purchase price. And we know the initial equity contribution is 33%, right? So this is 1/3 of the purchase price. And 2/3 of the purchase price must be leverage. 2/3 debt, 1/3 equity, seems pretty straightforward. So if I look at this, I'm going to have the purchase price times 2/3. And what is that? I know that's 6 times, right? The lenders are willing to put in 6 times. So 2 times the purchase price is 6 times. And if I solve for P, then I'm going to get 18 divided by 2. And Haley, what's 18 divided by 2 now?
9.
9x. So 9x. So if the seller is willing to come down to 9 times, then that deal would work at 6 times and 33% equity contribution. The key thing that I wanted you all to realize is that this is just simply a 3-variable equation. We can see that debt makes up one part of it. And we can see that equity makes up the other part of the purchase price. And if we add debt plus equity, then we're going to get the total purchase price. So, Haley, the point here was this is a 3-variable equation. If you know 2 of the variables, you can figure out the third one, and you should be able to do that during an interview. Haley, nice work going through this. Well done. Not many people get that the first time through, so nice job. Everyone, let's give it up for Haley. Henry and Jose also said no in chat. Let's give Haley a round of Zoom reaction hand claps for helping us out here. Haley, it's your moment. Just sit back and bask in the glory of the hand claps. Well done. Haley, what do you think? Does this make sense here? Anything we should clear up for anyone?
Honestly, I'm a little confused by the 2/3 part, like the fractions don't make sense to me. If you can explain that part.
Yeah, let's talk about that. So we know the purchase price, if we're talking about fractions, the purchase price is 1, right? The purchase price is 1. We can agree on that, right? And then we know that of this purchase price, there's only 2 components of it, debt and equity in this equation. And we know that equity is 33%. 33% turned into a fraction is 1/3. Can we agree on that? So if we know debt plus equity equals 1, debt plus 1/3 equals 1, that means debt has got to be 2/3 to equals 1. And so if I'm trying to figure out the value of the purchase price, what they have to come down to, the purchase price times 2/3, I know the lenders are willing to do 6 times. So purchase price times 2/3 equals 6 times. And then I just solve for P, which is 9. The other way to think about this, Haley, is let's say the transaction multiple is 9 times. What's 2/3 of 9? What's 2/3 of 9?
6.
6, which is exactly what the lenders are putting in there.
Okay, got it. Thank you.
Does that clear that up, or did that make it?
Yeah, that was helpful. Thank you.
Okay, perfect. Any other good questions here, team? Any other good questions here? Okay, perfect. So simple 3-variable equation. If you know 2 of the 3 variables, you should be able to solve for the other one. All we're looking at here is debt plus equity equals the purchase price. That's it. Debt plus equity equals the purchase price. Okay. Let's talk about other types of affordability analyses, particularly M&A. And here's what I want you to think about. If you're going into advisory work, even in a coverage group, an M&A group, you're going to advise clients on acquisitions, strategic decision-making. What do you think the qualitative factors are and the financial factors are that management teams frequently consider when evaluating M&A transactions. Do me a favor, drop into chat. What are some qualitative or financial factors that they would consider? Yeah, Caitlin, that's perfect. Synergies, huge part, Caitlin, huge part of a transaction. What else? Yeah, will it be accretive? That's an important consideration. No, we'll talk about that in a second. Yeah, Saskia, the price. What's the valuation multiple? Am I paying? Am I overpaying relative to acquisition comps? Am I underpaying? Am I getting a deal? The price is an important consideration. What other factors? What other factors? Yeah, the capital structure. Yeah, Kelsey, that's perfect. Can I extend market share? We'll put that under strategic rationale. Absolutely. Yeah. WL, strategic rationale as well. Perfect, perfect. So many of you hit on the key things, and you'll notice throughout this deck, I broke this out when I was putting this together. On one page, we've got an exercise. You should be working through this deck with a partner. And then on the next page, I got the solution. So many of you mentioned the key items, but let me highlight you. The ones that come up board meeting after board meeting are these. Many of you mentioned this idea of price or the valuation multiple. Many of you mentioned this idea of synergies. All that's important. Once you get past strategic rationale, the other items that matter are the timing and certainty of close. Management teams want to know, how long is it going to take to get this deal done? How long am I tying up my management team from focusing on my core business just to get the deal done? And after I spend all this money and time, what's the certainty of getting the deal closed? Do I have to go to a shareholder vote? What about antitrust or regulatory concerns? Who's going to be involved in the decision making? So I highlighted for you the key items that at least during an interview, you want to make sure you bring out: financial factors, price, valuation, multiple, synergies, as well as qualitative. Once you get past strategic rationale, what's the timing and certainty of close? These topics came up board meeting after board meeting in M&A. And then other items: regulatory considerations, the cultural fit, integrating the business plan, executing the business plan. Obviously, these deal with the ability to generate synergies, which is a huge part of it. Other items that I want to talk about now is, notice in a strategic acquisition, you're changing the income statement, you're changing the balance sheet, you may be changing the ownership. And so I want to talk about particularly accretion dilution with respect to some M&A back of the envelope math that you would do during an interview. Just like we did with some back of the envelope LBO math. So when I think about a merger consequences analysis, before we get into accretion dilution, do me a favor, flag this page, because I think this is the page that can help you with that level 1 response for the question, what is a merger consequence analysis, or what is an M&A analysis? And I'll tell you exactly the best practice answer. Here's exactly what I would say. An M&A analysis looks at the impact on the financial position of the buyer. And remember, it's a strategic buyer, not a financial buyer, from a few points of view. 1, what's the impact on the income statement? 2, what's the impact on the balance sheet? 3, what's the impact on the ownership structure, if particularly I'm issuing equity? And then 4, which not on this page, what's the impact on value? Am I creating value? Value creation, which I'll give you a hint, comes down to return on invested capital being greater than weighted average cost of capital. But I would also say in my level 1 response, in addition to identifying the impact on the income statement, balance sheet, ownership, and value, this M&A analysis helps me determine the price that I'm able to pay, the optimal form of consideration, and the optimal structure of the deal from tax purposes. Now, this helps you get the price, which is why oftentimes we call this an affordability analysis. which tells me how much I can afford to pay. An M&A analysis gives you that. So does an LBO analysis. Consideration is what the seller receives. What can the seller receive? Cash or stock? Well, what should I pay the seller in cash or stock? I want to know what's the impact on my income statement and balance sheet and ownership from paying them in cash and stock. And then what's the best way to structure the deal for tax purposes? So here's my level 1 response to merger consequence analysis. Let me pause here and take any questions. All right, now what I want to talk about, accretion dilution, and I'm going to get into some M&A interview math. Accretion dilution, the impact on the income statement. What you're doing, an accretive deal looks at the pro forma EPS relative to the acquirer's EPS. What is pro forma? Think of pro forma as the combined company. The combined company, so the acquirer and the target. Combined company EPS. Is the combined company EPS greater than the acquirer standalone? If yes, accretive. If the combined company is less than the acquirer, then it's dilutive, okay? Pretty straightforward. So I'm going to look at the acquirer's EPS relative to the pro forma combined company EPS. Now, there's a few ways during an interview where accretion dilution could come up. And how many people have heard of, give me a thumbs up if you've heard of relative PEs, this idea of relative PEs. Relative PEs. Okay, not many, and that's good. The reason why that's good is because relative PEs only work for 100% stock deal. Only work for 100% stock deal. I want to show you another method instead of relative PEs that will help you determine accretion dilution. So you can learn this. Feel free to learn it on your own. That's fine. But I'm going to show you a more robust method than relative PEs because they only work in 100% stock. Real quick, what a relative PE is looking at is just comparing the acquire PE and the offer PE of the target. That's it. But it only works for 100% stock. I want you to understand how to do back the envelope accretion dilution math if it's a 100% cash deal. If it's a 50-50 cash stock deal, I want you to understand that. And you can't use relative PEs in those type of transactions. So here's what I want to do. Please, again, you've got for relative PEs, exercise and solution. I don't want to teach you that because I want to teach you a more dynamic method. And that is earnings yield. Earnings yield will get you the same result as relative PEs, but at earnings yield you can use in every type of transaction, not just 100% stock. So I think earnings yield is more dynamic, which is why I'm sharing that with you now. Now, look at this. What is an earnings yield? Well, a PE is price divided by earnings. We can agree on that. The stock price divided by the earnings per share. The earnings yield is the inverse of the PE. It's basically the earnings divided by price. It gives you a sense for the yield of earnings based on the share price. And why does this matter? Well, before I talk about this slide on page 79, let me ask you a question and drop into chat the answer. How does a bank make money? How does a lending institution, a commercial bank, make money? They try to capture a positive what? A lending institution, a commercial bank, they try and capture a positive what? What's that called? A positive. A bank or lending institution tries to capture a positive what? Yeah, margin's one way to think about it. Yes, yes. Louise, that's exactly right. Interest spread. Teresa, that's exactly right. The net interest margin. Chinmay, that's exactly right. The spread over the risk-free rate. Leon, the spread. Exactly right, team. The bank tries to capture a positive spread. And what is that positive spread? What are the components of that? Well, this is a return. On one side, we've got the return on investment. And on the other side, we've got the cost of capital or borrowing. And what's in between here is a positive spread. Give me a thumbs up. How many people have heard of the saying, buy low, sell high? Buy low, sell high. How many people have heard of that? Yeah, perfect. That's how a bank makes money. It tries to borrow at a low cost of capital and invest at a high cost of capital, capturing that positive spread. What's a mortgage rate right now? What's a mortgage rate right now? Is it still at 12% or did maybe not that high? 7%, 6%? Yeah. And what are you earning on your deposits at the bank? Is that even 1%? Yeah, less than that. So my point is there's a huge spread. The borrowing cost for the bank is less than the return on investment. Now that we understand the capturing a positive spread, how does this relate to an M&A transaction? Well, what the acquirer wants to do is use cheap currency to increase earnings through M&A. So if, for example, the earnings yield is less than the borrowing cost, the cost of capital is less than what they get on the target, a return on their investment, then that's accretive. And again, why is this accretive? Because they're generating a positive spread. Now, if you're learning this idea of earnings yield, which is the inverse of the PE, related to M&A transactions for quick and the dirty accretion dilution math, it's great conceptually on page 79, but I think it's more valuable on page 80 where we can put some numbers behind it. So let's flip over to page 80 and put some numbers behind this. Notice Haley and I were talking about the LBO interview math. We gave you 3 numbers and asked a number of questions. Here, I give you 6 values: the PE for the acquirer and target, the cost of debt for the acquirer and target, and then the tax rate for the acquirer and target. And again, like we were talking about earlier, I think it's perfectly fine to flip over a blank sheet of paper and write it down. Here's what I want you to figure out for me. What is the earnings yield on the acquirer? Drop into chat. What's the earnings yield on the acquirer here? What's the earnings yield on the acquirer? We gave you 6 values. Leon, perfect. Henry, perfect. Sylvia, perfect. Chinmay, perfect. Perfect. Daviel, perfect. 1 divided by 25 equals 4%. Nice. Well done, everyone. What's the earnings yield on the target? Leon, Henry, Caitlin, Sylvia, Chinmay, spot on 5%. What's the post-tax cost of debt for the acquirer? What's the post-tax cost of debt for the acquirer? Yeah, perfect. So let's look at that. Henry, spot on. Caitlin, spot on. Santiago. So I've got 8%, right, times 1 minus the tax rate. That's going to be 4.8%. And then what's the cost of debt for the target? What's the cost of debt for the target? Yes, yes. Felipe, Sylvia, Chinmay, that's exactly right. 6%. Okay. Now that we arranged all this into yields, notice the PE, we took the inverse of that. We took the after-tax cost of debt because debt has a tax shield. Now we can figure out for a 100% stock deal, for a 100% stock deal, 100% stock deal, is there a positive spread? Is it accretive or dilutive? Yes or no? 100% stock deal, accretive or dilutive? Yes or no? So the acquirer uses their stock, which has a yield of 4%. They get the target stock, which yields 5%. That's a positive spread, so that's accretive. That's accretive. That's accretive. If you mention dilutive, let's talk about it. Any questions there? If you mentioned dilutive, any questions? 4% is less than 5%. That's a positive spread. Got it, Caitlin. We can talk about that here in a second. All right, so 4% less than 5%, that deal's accretive. That's a positive spread. I take 4%, I'm able to invest it 5%. That's great. Now, when we talk about cash, yeah, we'll talk about PE in a second too, Noah. Since we're doing earnings yield, we're looking at the yield, not the PE, but we can circle back to PE if it's helpful. Now, when you talk about stock and cash, this is consideration. And what is consideration? Consideration, we said, is what the seller receives, not how it's financed. So consideration is stock, consideration is cash. And usually that stock deal is funded with 100% debt. 100% debt finance transaction, and the selling shareholders end up getting cash as part of that deal. So what does the acquirer use? What's the yield on what the acquirer uses? What's the yield on what the acquirer uses? The yield on it, they're raising debt. What's the yield on the debt? Yes, exactly right, Chinmay Leon. 4.8%. And everyone drop into chat. What's the yield on what they're getting? What's the yield on what they're getting? Drop that into chat. Yeah, this is great. What determines ownership? It's equity. It's equity, not debt. So we're raising debt at 4.8%, and we're buying the target's equity, which yields 5%. What happens to the target's debt in an acquisition? It's either rolled over and remains a liability, or is refinanced and remains a liability. If I buy the target's debt, then now that becomes an asset, which it's not. So in an acquisition, to control a company, to own a company, I purchase its equity. So in both cases, I'm getting a return of 5%. Now, the reason why I wanted to show you this is relative PEs only worked for 100% stock transaction. But as you can see, there's differences in a transaction issued in cash, or even we can look at a 50-50 transaction. Let's do this math here. 50-50 cash stock, 50-50 cash stock deal. And so 50% of, let's see, the stock is at 4%. So that cost is 2%. 50% of, this is stock. And this is 4.8%, which is from debt. 2.4%. Remember, the acquirer raises debt and issues cash as consideration to the selling shareholders. So together, a 50-50 transaction is 2% plus 2.4% or 4.4%. And so we've got the acquirer at 4.4% less than, what's the return on the equity from the target? It's still 5%. So this is also accretive. And notice, look at this. Hopefully this symmetry makes sense. 100% stock deal is 4%. 100% debt finance deal is 4.8%. And if we go 50-50, what's halfway between 4 and 4.8? What's halfway between 4 and 4.8? 4.4. So that math works out, right? So in all cases, it's accretive. And hopefully that you can see how this is a little bit more dynamic than just relative PEs. Now, the question for you is, which would have a higher accretion? 100% stock, 100% debt financed cash deal, or a 50-50 transaction? Which would be better? Debt, cash, or a mix? Yes. In this situation, typically an equity finance deal, a stock deal, is higher. And why is that? Well, I'll bring us back to relative PEs, which says, yes, Daviel, Shinmei, that's exactly right. Sylvia, you're getting to the key point here. It's getting a higher spread. It's getting a higher spread. And why is that? I'll take you back to relative PEs. If I look at the acquirer's PE relative to the target's PE, the acquirer's PE is greater than the target's PE, which means it's going to be an accretive transaction. It's going to be an accretive transaction. But we're in the advisory business as investment bankers. So let me ask you, while numerically equity would have the higher accretion, a debt deal would still be accretive. So typically what happens in an interview after this question here, you're typically asked a follow-up question, which is, why should you advise a client to use debt over equity? Or what are the benefits of debt over equity? We'll talk about that question in a moment. But before I move off of page 80, let me take any questions on earnings yield to determine M&A accretion dilution back of the envelope. Again, here we gave you 6 values. We would ask a question like this. This is actually taken from a question we would ask pretty much every interview, not the first round, but second round and third round interviews. We would ask a question like this in JP Morgan in the M&A group for people that were looking to come into M&A. Can you do some back of the envelope items like this? Let me take any questions here. Let me pause. Let me take any questions. We've got time. Okay, this idea is earnings yield to calculate accretion dilution back of the envelope during an interview. The question that we're left with is, equity is going to yield a higher accretion, but what are some things that you should consider when advising a client with respect to issuing debt or equity? And here's how I want you to think about that. On page 82, from the acquirer perspective, what are some advantages of 100% stock? What are some advantages of 100% cash, new debt raised? Do me a favor, drop into chat. We'll do this together. Do me a favor, drop into chat. What are some advantages of 100% stock transaction? The acquirer using stock. What are some of the advantages over debt? Drop in the chat. What are some of the advantages of a company using stock? Yeah, don't owe interest. In this case, a higher spread, Leon, but that's not always the case. Absolutely. Yep, Caitlin, that's right. Stock value may be at an all-time high. Yep. No, Sylvia, that's spot on. No debt repayment. Yeah, perfect. Taxes. Yeah. No interest payment or repayments. Yep. No extra interest expense. Yeah. The seller shares the risk. Yeah, that's a big one, Zachary. Yeah, Kelsey, maintain the cash cushion. Those are perfect advantages for 100% stock. Also, one other one is you don't need the market. The company can just issue stock. Whereas if you issue debt, you have to go to the debt capital markets to raise that debt. What's some advantages? Let's look at it from the other perspective. What's some advantages of 100% cash debt finance transaction? Seller receives cash, target raise new debt. What are some of the advantages of that? Oh, Sylvia, that's a big one. Usually less dilution for ownership. Absolutely. Yeah, Saskia, typically debt's cheaper than equity. That's right. What else? What are some advantages? More predictability. Price won't change based on share price. Yeah, the seller may want that, Kelsey. That's a good one. Seller may want some certainty. Yep, Alan, that's exactly right. All right, perfect. So like you saw throughout this book, we've got a mix of exercise and then solution. So I wouldn't expect you to memorize this entire page, but at least have a few ideas available in each of these. We covered a number of stock, ready, available, no interest expense, permanent capital. They share in the risk, 100% cash, no shareholder dilution, more EPS accretive, typically lower cost of capital, signals confidence in the future cash flows. That's another big one. Some downside, 100% stock is dilutive. Typically higher cost of capital, higher premium, may require a shareholder vote, which could impact the timing or certainty of close. We talked about the big issue of that. And then downsides of debt, requires debt markets. There is interest expense. There could be impact to your credit profile. We talked about looking at the impact on the balance sheet in the M&A analysis also. And then here, the acquirer shares 100% of the risk of the synergy realization. All right, let me take any questions here. And look, there is time. So what I'd like to do, since many of you alluded to it on the previous page, is talk about why relative PEs work. So let me pause here, see if there's any questions, and then I want to go back to relative PEs so you can see we've talked about the what, but also I've been focused on getting you to the why. So I can explain some of the why around relative PEs and why earnings analysis works with the time that we have here. So you can see we're done, but let's flip back to relative PEs because this will help explain the why. So we saw the what in the calculations for the earnings yield. Let me explain the why of what's happening here. Did you flip back to page 76? Give me a thumbs up if you flip back to page 76. Page 76, you flip back. All right, perfect. I want to talk about the why this back of the envelope accretion dilution techniques for relative PEs and earnings yield works. Here's the idea. I'll give you this for PEs. What happens is when the acquirer's PE is greater than the target's offer PE, it's accretive. And let me flip back and show you. You don't have to, but see, the acquirer's PE is greater than the target's PE. And we said 100% stock deal was accretive. So that checks out. Why is that though? It's because there's a lower exchange ratio, which means you're issuing fewer shares. You're issuing fewer shares. And those fewer shares ends up impacting the pro forma EPS in a positive way. Again, this is the conceptual. Let me put some numbers behind it. Everyone flip to page 78. Flip to page 78. Page 78. So we're talking about the why. Why does relative PEs, why does earnings yield work? That's where we're at right now. Why does it work? Well, let's look at this first scenario. We can calculate the acquirer's PE, stock price divided by earnings per share. You can do the math, but you would get 20.5. We can calculate the target's PE. At the offer price, they're offered $91. The target's earnings is $350. That means the offer PE is 26. Now, in a 100% stock transaction, the acquirer exchanges shares with the target. And you want to figure out what's that exchange ratio in terms of the exchange ratio says if the seller gives up 1 share, how many shares of the acquirer do they get? And the way to calculate that is by taking the offer price, and you can think of it like this. The target is owed $91.80, and the acquirer is going to give them their stock worth $67.52. So how much stock of the acquirer does the acquirer have to give the target if their stocks were $67 and they've got to give them value of 91? Well, they've got to give them 1.36 shares of the acquirer to get to value of 91 for the target. And if I look at the shares issued in the transaction, we've got the offer value. So this is what the seller receives, $14 billion. The acquirer's stock is 67. So they're giving, the acquirer's giving the seller 210 shares. 210 shares is what's giving. And now we're going to calculate pro forma EPS. And if I scroll down here, you can see that the pro forma net income, acquire plus target. And then I've got the acquire shares. I add in the new shares that were issued to the target, and that gets me the pro forma shares. And look how much my pro forma shares are, 753. That gets me pro forma EPS of 3.9, which is less than the acquire standalone, and this is a dilutive transaction. This is dilutive. Now, let's look at scenario 2 and look at what's changed particularly. The acquirer's price goes up to $90, which means the PE multiple goes up to 27. The target multiple stays the same. So drop into chat. Based on what you know, the acquirer's multiple is greater than the target's multiple. Is this an accretive or dilutive transaction? Drop it into chat. Accretive or dilutive? Drop it into chat. Acquirer's PE greater than the target's PE. Accretive or dilutive transaction? Yeah. Saskia, that's perfect. Yeah, Felipe, accretive. Haley, accretive. Yeah, accretive, accretive. The acquirer's PE is greater than the target's PE. This is accretive. But let's look at why. Let's look at why. Notice what's happening. The exchange ratio is lower, which means the acquirer issues less shares. $157 because it's got a higher stock price for the acquirer, 157 versus 210, which means that if I look at this, the pro forma net income is the same, but the number of shares in the combined company is less. And as a result of lower shares, I've got higher pro forma EPS, which is now greater than the acquirers. And that is, as you all mentioned in chat, an accretive transaction. So the why here is why this works. If I was explaining this during an interview, is I would just say a few things. Why this works is that the exchange ratio is lower. I'd say that, which results in fewer shares being issued, which results in fewer pro forma shares, which results in a higher pro forma EPS, leading to a more accretive transaction. So I gave you the what and the why. And also, if you want to review this, the solution, but the why behind relative PE's working deals with those items. The exchange ratio is less, which means I'm issuing fewer shares, which means the total pro forma shares is less, which means my EPS is greater. And that's a accretive transaction. Let me pause here and take any questions. All right, perfect. So we covered relative PEs, we covered earnings yields, and we walked through the why this works for a 100% stock transaction. And that gets us to the end here. There's some additional resources, particularly on this page. Look at page 86. There's additional, if you enjoyed the problems that we went through, there's additional practice problems and solutions right here that you can focus on.